That you use to hedge risk, which felt like a very 2021 trade to me, and yet you look at some of these miners, perhaps shorting the miners might be a move. There's so many different ways to think about this.
Depends how you want to play the commodity trade. The real question this morning, though, is it's not the BOJ, it's Samba or Gazelles. I'm fascinated to see how Adidas trades this morning, Adidas trades this morning, because you could potentially see a ripple effect back into some of the US names as well. Yeah. Like what happens with Nike, what happens with Puma is going to be really interesting in that kind of read-across story. So European markets are open. I don't think you expect too much. I think there's some really interesting names out of Europe today. I think these are companies that actually have a read across into the wider macro story. I think Inditex is definitely one of those. I think it speaks to the AI story. I think it speaks to the kind of the omni-channel story as well. Adidas tells us about the consumer, the Volkswagen story as well. That's at the heart of the German kind of industrial narrative right now. If VW can get back into gear, then that's going to have a big ripple across into the rest of Germany.
Yeah, interesting to see where all of these big German global names are putting their hopes. And in the case of the car makers, it's on new models. It's that's the line coming through from VW. More on that shortly. In the case of Adidas, they're talking about guiding towards momentum later in the year. So the first half of the year still being a little difficult, but later in the year we get that momentum. I mean, that isn't to play on the European economy necessarily, because this is global businesses. But you know, there are some people talking about whether we might see some kind of turnaround on the European side of things from a macro perspective later on this year.
Yeah, it's interesting that we're talking about momentum. We're talking about kind of where the consumer stands. Don't look at me when I said momentum.
You're not allowed to use that word.
You've not trademarked it yet. But the reason I bring it up is because one of the biggest downside movers in the FTSE this morning is going to be Intercontinental, so IHG, and it's down about 2.3%. And initially, you don't see any kind of fundamental moves there, but it's actually coming off two analyst downgrades there. Bernstein cutting it to underperform, and so is Jefferies cutting it to a hold from a buy, both citing that domestic trends in the United States are not favoring the company, that helping weigh down the FTSE this morning.
It's had a great run, though. You look at some of these stocks. So in October, this stock was trading kind of less than 6,000. It's now trading 82.90. Yeah. So you've had some really strong runs. It's again, this is part of the Taylor Swift economy. It's basically the fact that we still want to spend on services, we still want to spend on travel.
Yeah, really interesting that if you break down that services side, I was looking at some research from Bloomberg Intelligence on hotels versus airlines, and they're arguing that European hotels are outpacing the legacy airlines in terms of EPS. There's this divergence between these two trends. And they're both driven from the same place, but there's some interesting constraints perhaps on the aviation sector where there haven't been on pricing on the
to that point, I wonder whether the Boeing story with the MAX and to a certain extent Pratt & Whitney is going to basically keep airline fares high this summer. This is something that I spend a great deal of time thinking about, and that airline story, the lack of capacity is going to be really interesting in terms of what that means for pricing and therefore the ongoing inflation story, whether you close that gap with the hotels.
Let's talk about one of the other stocks actually doing really well this morning. BNP Paribas is one that we haven't talked about, higher by 2%, one of your biggest volume movers to the upside this morning. 400 million euros of cost-cutting measures seem to be well received by this market, at least in initial trade. But a 2% move higher at a time when you're not seeing that much volatility in some of these stocks, I thought that was quite interesting.
Yeah, banks again, this kind of this story around Europe and what happens with Europe. I think, are you going to see a reacceleration in that economy? I think there's also this idea that banks also potentially are getting a more favourable read from maybe some of the regulators as well.
We've been talking about retail a lot this morning, and so worth mentioning that retail is the best performing sector on the GRR function this morning on the Stock 600. Retail, by far and away, the best performing sector, but it isn't Inditex, although that is up by 2% or so. Zalando up by 11%, just just north of 11% on that particular German business.
With numbers this morning.
They were out with numbers as well this morning, which we haven't dwelt on, but we've talked a lot about the broad retail story. They put a new strategy together, it seems. Paving the way to profit seems to be one of the analyst reaction lines coming through.
I think there's a lot of caution around what has been happening with that kind of more fast fashion end of the spectrum, and trying to figure out the strategy. I think has been a key kind of part of that. So I think the market has been
the sustainability of those strategies.
Precisely.
Clearly they're nailing it in terms of being fast fashion and getting the fast turnaround, but. Can you manage the returns process? Something we talked about with Deirdre Hitwell earlier on.
Unshopping.
I like this.
Unshopping.
This new verb.
But basically all of their working capital basically exists in everybody's houses. So all these retailers have basically got so much out there. Let's talk about Volkswagen. We've had a conversation with the CFO. What is interesting here is basically what happens with electrification, and I think that is the key theme. The electrification story has fallen flat to a certain extent, but Volkswagen is still continuing to push really hard.
30 new products this year, planning for 30 products. I mean, that sounds like a lot. I
think if you take the tops off, there are similarities between many of those products.
And we talk about the share price. Shares down 0.7%, despite the profits actually coming in higher than expected. If we're talking about these new models, how much demand actually is there for the EV story? I think that's going to drive not only what the Volkswagen story, but the global EV story as well.
And how much of this is in Volkswagen's control? How do you reignite this story? This is what the CFO has to say.
The future will be electric, and we are preparing accordingly. But different markets develop in different pace. China is developing rather fast towards electrification. In Europe and US, slightly slower. But we're convinced with more models available, both in the premium segment and also in the volume segment. And as you know, we bring also a 25,000 euro car in 2026. With more affordability of electric cars, and also with the increase of charging infrastructure, we will gradually see an increase of the BEV share in the overall market.
And do you think that so it seems like regulators and consumers maybe want different things. Do you think 2035 is a realistic target in Europe to get rid of all combustion engines?
As said before, we have an ambitious transformation plan towards electrification, and we are planning accordingly. Up from here to 2025, it's up to the customers to choose. But from a regulator side, we need stability, and we have that stability in Europe. We have a decision, and we are planning accordingly to 2035 run out of combustion engine cars. And this is how we set up our investments.
And then in terms of the cost cuts going forward, because if it's not going to be a very strong growth year and maybe pricing power isn't where it has been the last couple of years, you're going to have to focus on costs. Where are the cost cuts going to come? And can you get VW to where it needs to be on margins?
No, you're quite right. I said 2024 will be a challenging year, but we launched really ambitious efficiency programs, not only in brand Volkswagen, also in brand Group Core and the whole group. And they will be very important to support our profitability. Look, Oliver, we are in an industry in transformation. We have great products, but in order to be able to powerfully invest into the future, we need sufficient profitability. And the cost improvement has to come from, at least the major part has to come from the fixed cost side, overhead costs, other fixed costs, also improvement in productivity. These are the things we are looking at.
And thinking a little bit about also your growth and your future, obviously China has been an absolutely crucial and immense market for Volkswagen. However, it's basically flatlined last year, 2% growth only when you did 20% in the US and North America. What is your assumption for the Chinese market over the next 12, 18 months? Is it that it will not really contribute that much to growth?
So this is a very valid question. To understand it, I must give you a little bit of broader view. We launched a catch-up plan in China. We realized we brought great products, but we had to catch up. We have to catch up specifically in driving assistance function, in-car infotainment, also we need cheaper batteries, we need LFP batteries. All the competitors have LFP batteries. We have more expensive one, NMCs. And we launched this catch-up program. And in addition to that, we bring two new cars on a platform from a partner. But these measures will take until 2026. And along with our value over volume strategy, we are deliberately prepared to give up market share in the next, I would say, 1 to 2 years, 2024, 2025, in order to find a sound compromise between margins and volume. But from 2026 onwards, we want to regain share also in the BEV segment.
And so by 2027, let's say, where would you like to see market share for battery electric vehicles in China?
The battery electric vehicle market share in 2027 should approach, like from 2027 onwards, the share we have currently in the market in average.
Okay.
But not from 2024 to 2026, but rather 2027 onwards.
And in terms of, obviously we have this EV probe going on from the Europeans into China. Are you concerned that that is going to come back as retaliatory tariffs with some of your models that you produce in Europe going over to China?
We are a global company, and we stand for free trade. We stand for open markets, and this is where we stand for, and this is what we advocate for.
Arno Antlitz there, the CFO of Volkswagen, speaking to our very own Oliver Krug, who joins us now for more about the story from the carmaker's annual media conference in Berlin. Ollie, walk us through some of the responses that we just heard in that tape with the CFO. What does Volkswagen hope to achieve today?
Yeah, I think it's really interesting what we heard, particularly on the comments on China in terms of really being willing to give up market share for the next couple of years. And that really speaks to kind of at the heart of what's going on at Volkswagen right now. If we just think about this and step back a little bit, last year was really the year in which they restructured the business. That's when they announced that 180 billion euro spending plan over 5 years. I mean, 180 billion euros is like 3 times the market cap of Volkswagen, just to give you the scale of how much spending we're talking about to get into it. And this year is really all about execution and really convincing shareholders that they'll be able to execute on this and getting the profitability to where it needs to be. And you had a little bit of that yesterday with the Porsche numbers, where actually you gave a pretty gloomy outlook. Margins came in a little bit lower projected for this year, but actually investors were buying into the growth story longer term, and Porsche shares were up 11% yesterday, the highest on record, right? So that was, a massive move. And then really 2025 will be about kind of opening up, and 2026 is when this will pay out. So this is really an immense transformation year. The risk, of course, of giving up market share in China is that it's much easier to defend market share than to regain it for battery electric vehicles.
I'm thinking about battery electric vehicle sales then, Ollie. What is the VW line on that? Because this is an area where we've been watching the European sales data retreat to some degree, sales not rising as much as they had in the past, and a little bit of consumer hesitancy for various well-documented reasons.
Yeah, completely. And so this is what we saw also. I mean, we heard from the CFO and got a little bit more details on the numbers for actually just the beginning of this year, and that actually BEV sales are up year on year compared to last year, which is at least a little bit of growth. But again, the expectation is overall that this is a much smaller market than a lot of people had anticipated going forward, which makes the task for Volkswagen a lot more complicated, obviously, because Tesla and BYD are way ahead in terms of the volumes of sales on this. And if the slice of the pie is a lot smaller than initially anticipated, and you have a huge number of different competitors coming in, it makes it a lot harder, for Volkswagen. I mean, in the fourth quarter, 10% of the cars that they sold were battery electric vehicles. But what's also interesting is that there's also this huge impact in the secondary market, because when you're buying a car, obviously you care about how much the resale value is, and we've seen the prices of used BEVs fall something like 30%. And this is obviously going to kind of put people a little bit ill at ease, particularly when you're thinking about what car you're going to buy and why not just buy a used one a year later. So this is all part of the complicated cocktail of policies, because a lot of this has to do with the fact that they front-loaded subsidies, and so as a result, that hurts in the secondary market. So this is really something for policymakers and car makers to try to really work out on what is the stable market for the battery electric vehicles.
Ollie, I've got 2 questions. One, is that a red 911 behind you? I'm kind of looking at the shape and I'm trying to figure it out. And the second question is...
It is.
It looks pretty, but it's out of focus, so I can't quite see it. Give me the breakdown within Volkswagen as to what is happening. Are the upper end brands still producing a lot of the money in terms of where we're seeing that BEV story? Is it Audi? Is it that upper end that is producing the better results? Is that beginning to trickle down into the Volkswagen own brand, etc.?
So this is something that we got from the breakdown of the numbers today. So I'm glad you asked that, Guy. And that exactly that. Looking into last year, 2023, what were the sales rises on, right? They did 15% sales increase overall. But when you go into the volume and kind of the lower end stuff, that only did 5.3%. When you go into the Lamborghinis, you go into the Audis, you go into the Ducatis, that did 13%. So that sort of premium sort of part of the segment of the market is still very much intact. And you see that as the numbers were dropped just today.
Yeah, it's interesting that is where continues to be where the money has been making. And you look at kind of what is happening with Porsche, and then you look at what is happening as well with Ferrari. You look at kind of the multiples some of these stocks are trading on. It's amazing. Trying to get Porsche onto those sort of multiples, and then maybe ascribing those sort of values back into Audi, etc., within the Volkswagen brand. Ollie, great stuff. Nice interview. Thank you very much indeed, Oliver Crook, on what's happening with Volkswagen this morning. Let's talk a little bit. This takes me on to the what we're going to call the sensational six. Now, you've got the Super 7, which I think is Beata Manti over at Citi. We can't do that because we can only get 6 on the board. But you've also got the Fab 5. I think that's Deutsches. You've got the Granolas. We're going to call this the sensational 6.
Have you trademarked this in some way?
Credit Goods is going to trademark this. But basically what we're looking at here are these stocks that are having such a massive impact on what is happening out of Europe. And it's worth checking, I think, because this is where the impact is coming through. You've got Nestle in there. Schneider is the big surprise. Everybody apparently is talking about Schneider right now. But it's interesting that LVMH is a little bit soft this morning. Ferrari, again, continues to move higher. But these are the stocks that I think are at the center of the European story right now. We talk a lot about other stocks, but I think it's worth checking in on the sensational 6 every day.
Yeah, and the Schneider, connected to the energy transition story.
That's the AI story. It's the AI story. Yeah. They provide all of the infrastructure gear, the network gear that goes into that AI story, which is so hugely power consumptive. That takes me back to the Bitcoin story. Have you seen the power consumption story around Bitcoin at the moment? Absolutely epic. That's how I make the connection.
Well, this was one of the concerns, right? I can learn out about electricity grids a lot, but the short story is that one of the kind of angles of the kind of geopolitical story in Russia as well was that so much of the Bitcoin and crypto mining happened there because of those cheap energy costs. Yeah. If you do start to see energy coming down or get cheaper in the likes of Austin, Texas, for example, Berlin or other places, that
this is where the Bitcoin story is inflationary.
Yeah.
Bitcoin activity picks up, electricity prices go higher, that feeds through into what we ultimately have to pay, and that's where the inflation story is. So that's the connection between Bitcoin going up and inflation staying sticky.
And is that on regulators' minds in a way that perhaps it could be?
Well, it's interesting that they're talking about you can't connect. We're struggling to build the server farms because of the fact you can't connect them to the grid because there isn't enough power.
Yeah,
anyway.
Which sounds like something that somebody might look at one day. Right, let's check in on some of the individual stocks that are on the move. I wonder if any of our sensational 6 feature or if Joe's eye has been dragged elsewhere. Joe Easton is here from our equities team with a briefing. Joe.
So I can't keep my eye off the fashion stocks at the moment. We're taking another look at Zalando, up 17% now. That's the biggest gain in 5 years for the German company. It's kind of a German version of ASOS, the UK company we've got here. Their sales guidance, not actually that strong, predicting a sales decline of 2%, but some of their costs much lower. Some of their fulfillment costs over in their warehouses coming down. Seems to be the main key focus there for analysts. But Adidas coming down 1.6% at the moment. They are selling more of this Kanye West stock out of profit, but why haven't they upgraded their guidance is the question being asked by analysts today. So the stock coming down a bit, but Inditex, the owner of Zara, powering on, up another 4%, up 45% over the past 12 months. It's an unstoppable beast in the fashion world, the owner of Zara, and it's continuing to rally. Then switching over to utilities, we've got E.ON announcing 40 billion euros of investment in the energy transition, but their guidance on their earnings looking pretty strong as well, so that one is higher. A couple of stories in terms of buybacks to bring you. Balfour Beatty up 8%. The UK builder worries about declining earnings after the HS2 project in the north was scrapped. That was one of their biggest projects, but they are doing 100 million in buybacks today, so the stock up 8%. And you mentioned BNP Paribas, 400 million euros worth of cost cuts, and they're going to buy back around 20 billion in terms of both dividends and also buybacks over the next few years. According to a statement today, that's the total cash return, 20 billion euros they are projecting. Sandoz coming down a little bit, the drugs maker, that's generic drugs, but done well since it was spun out of Novartis a few years ago. It's not surprising to see that one come down. And we did have another profit warning out of Solvay over in chemicals, but we've had a lot of warnings from that sector, so potentially already priced in terms of the negativity there. So that one actually rising today. A few deals to bring you. We've got one over in the metal space. ArcelorMittal buying a big stake of Vallourec. This is the maker of tubing, metal tubing in France. ArcelorMittal coming down. It's around 700 million that they will be spending on that deal. And I wanted to bring up Lion Trust today. The UK asset manager reports in the Financial Times of a potential merger with Artemis. Surprisingly, though, not seeing a big gain in that one. Pretty much unchanged, but a couple of deals in focus this morning.
All right, Joe Easton from our equities team walking us through some of the key stock stories that we need to know. We thank you so much. Coming up on the program, we go from the micro to the macro. The yen strengthening as the world's largest car maker, Toyota, agrees to wage hike demands from unions. This adds to the case for a BOJ policy shift going into next week. Plenty to discuss coming up ahead. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back to Bloomberg Markets today. Let's talk FX. We are pretty flat on dollar yen right now, 147.72. We have seen a bit of volatility. Toyota doing a deal around wages. That takes us into some wage data later on this week. Let's talk FX with Stephen Gallo, Global FX Strategist at Bank of Montreal, who joins us on set this morning. Very nice to have you with us, Stephen. So let's start here, because there's a lot of excitement, if that's the right word, about whether we see a change in policy from the BOJ next week or whether we have to wait a little bit longer. It still would be a surprise to markets, right, next week if it happened, or is this moving pretty fast?
It depends what we're talking about in terms of the policy change. At this stage, I don't think a change in the guidance on interest rates, firmer guidance that is, more hawkish if you like, would not be a surprise, and I think there would probably be a bit of disappointment in that. We're looking for a slightly later move by the BOJ. So more spring than we currently are about to be. Yeah.
So every BOJ decision, traders are getting it wrong. Every single one. Disappointed. I think it's going on for like a year or two now. How do you position going into next week?
I think in terms of the customer conversations that I've been having around this, I think, I mean, given that the carry is so appalling to be long yen versus anything, the impression that I'm getting is that customers kind of want to play it from the long volatility side. Because what if the BOJ does surprise markets hawkishly? What if it disappoints markets significantly? And then, I mean, I think at the same time, within there, you've got the risks of a liquidity or an illiquidity event in the yen. Because of a lot of these trades that have been funded in yen. If there is one vulnerability within the global financial system, the global monetary system, or even just the FX market globally, that is one of them. Something that causes a massive unwind of those trades.
Okay. Surprises, I think, are interesting, and kind of we're looking for kind of catalysts that could create one of those. And I'm wondering if central bank sequencing could be part of that narrative as well. The expectation currently is that the ECB and the Bank of Japan, the ECB and the Fed are going to go roughly at the same time. The Bank of England, we've seen data out this morning. The UK economy appears to be stabilising maybe a little bit later. If that sequencing starts to drift apart, if that expectation of a reasonably kind of tight grouping of those central banks making cuts starts to change, i.e. if the Fed dot plot, for instance, goes from 3 to 2, how does your world change?
Yes, you're talking about a situation where volatility in markets, FX in particular, which has been a very dull game, let's face it, year to date and part of last year, will change. The environment will change. And it's not something I think most investors are currently expecting. I think most are expecting there to be for central banks to sort of meet around summer and start moving. And that's roughly just before, right around the same time as when we're expecting the BOJ to do its thing. But you're talking about a situation that would spark volatility. It's certainly a concern, but don't forget that one of the things that central banks loathe is volatility, extreme volatility in the exchange rate. And I think that explains why the BOJ it's sending these mixed signals. It does not want the market to have the upper hand in this.
Yeah. Would that mean that the ECB would be brave enough to go substantially before the Fed? Brave is not the right word, but would they be, their assessment of the risks, would they go substantially before the Fed?
There's an economist at BMO that I speak with regularly who hates the terminology waiting for the Fed. But I honestly do think a lot of these central banks want to see the Fed move further along the lines on the pivot before they move. So I can see the ECB moving. In fact, we have the ECB penciled in to move before the Fed. But I think the Fed will probably have to do something a little bit dovishly first, either in the interim rhetoric between meetings or at one of the next coming policy decisions.
Haven't seen you for ages. Definitely come back again more often. Really nice.
Thank you. Good to be here.
Global FX Strategist joining us from the Bank of Montreal. Coming up, we're going to talk about Poland in DC. That story next. This is Bloomberg.
Trends in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We are the nation who was enslaved by Russia several times. If Russia wins the war in Ukraine, if Putin wins the war in Ukraine, he will attack one more time. He will attack other states because this is Russian imperialism reborn, and it is greedy. It will be willing to attack further. That is why it has to be stopped. It has to be blocked, and it has to be punished. And this is the most important task that is facing the community of the West today.
Polish President Andrzej Duda speaking exclusively to Bloomberg Television at Balance of Power there. And Poland is such an important story, of course, in the context of the Ukraine, the war in Ukraine, I should say, but it's also important in the context of NATO and the defense budgets there as well. Poland, I think you made this point yesterday, Guy, is the only country in NATO right now, besides the United States, that's actually exceeding that 2% GDP number, and actually making the argument at the White House yesterday with President Biden that that should continue, that the norm should not be 2% GDP, perhaps even 3%.
Or I think it's the only one doing even better than that, perhaps.
So I think it's on 4%.
Yeah.
So, but you understand kind of where it is. You need to put that number in context to kind of where it sits. As you say, on the front line, it has significant threats as a result of what's happened in Ukraine. But the threat it's warning about is that if Ukraine loses this conflict, you would expect Putin to do more and potentially threaten NATO members. And the market reaction is much more muted now to Ukraine. But if that threat were to materialize, and you think Ukraine is an issue, you're into whole kind of attacking a NATO member.
Yes.
Even if Trump were in the White House, that would be quite different territory.
I was reminded reading the story about that. Actually, this is a Polish leadership that has had not too bad relationships actually with Trump in the past, and so the fact they've gone to Washington on the front foot to sort of talk about how much they spend in relation to their GDP on defense is obviously a way of getting ahead of any skepticism from any incoming Trump administration, if that what we saw. And in fact, I was reminded by the story that actually, back during the Trump presidency, the Polish leadership actually offered to put Fort Trump in Poland back in 2018. So this is a relationship that we have watched and will continue to watch.
I'm curious as well about, there's the geopolitical relationship and then there's the relationship into the markets as well. When you think of Poland, you think of the domestic pressures that are happening there. Yes, they're dealing with a war really on their doorstep as well. They're also dealing with a lot of internal pressure around things like farming and grains and the commodity picture as well. We had our correspondents across Europe cover this quite aggressively in terms of protests in farming and protests in terms of Ukraine and the subsidies that go into kind of the grain manufacturing there that are perhaps kind of overshadowing or stepping on Poland's own exports on that front.
So there has been restrictions, and Poland to be front and center of this in terms of Ukrainian product coming into Europe.
Yeah.
The commodity, Ukraine in so many ways, if you think about the European economy, has been a commodity story. It's largely been an energy story. It's been an energy crisis. That's been the big shift as a result of that conflict. And that continues to manifest itself. You look at the crisis we often talk about, we talked about it today in Germany, that is an energy crisis, and that still continues. We have diversified, but we still rely... We have had to change very quickly, and Germany has had to change very quickly in terms of the energy mix.
I think it's interesting that, you talk about the pressures that the war in Ukraine has put on, for example, the Polish economy and economies around it. I think it's interesting that we have seen tensions flare up between some of those Eastern European countries, but not very often, and that speaks to the threat, doesn't it? That speaks to the thing that unifies at this time, which is that threat from Russia.
You think all of the Baltics are on the same page, Poland is on the same page, you look at Sweden and what is happening there in terms of the defence spending that is going on, fortifying key islands in terms of making that country ready for that potential threat as it grows. But the energy story is... It kind of takes us into the space of the energy story. So let's kind of focus there on what is happening. Vår Energy, which is majority owned by Italy's Eni, is hosting its Capital Markets Day today. It's Norway's third biggest producer. It's targeting oil and gas volumes as many as 400,000 barrels a day until 2030. Nick Walker is the CEO of the company, Vår Energy, and joins us now. Nick, let's just talk about your expectations for what demand is going to look like. You're laying out your production estimates, your production story going forward, and part of this is the Neptune acquisition. Talk me through what you expect the next few years to deliver in terms of energy demand. Norway, the Barents are key areas that Europe is going to rely on going forward. How much demand do you think you're going to see, and do you think that demand is going to justify further exploration?
Yeah, no, it's a good question, and of course Norway is a key supplier of energy to Europe. It's reliable, it's secure, and it's right on the doorstep, of course, and so it's an important supplier, and we're one of the bigger ones, as you say, the third largest supplier of energy, and all of our product goes into Europe. We see long term that the demand for oil and gas is going to stay high. Of course, the world is transitioning to other fuel sources, but we also see the population growth, energy demand growth. So we see that the demand will remain high for the long term, and we will invest into that. I think the key thing is the industry needs to decarbonize, and it needs to do it low cost. And we're doing both of those things to make ourselves relevant, investable long term.
In terms, just sticking with the supply-demand story, Europe has had to change its energy mix. As you say, Norway has become a much bigger part of the mix as a result for many European countries. And I'm wondering whether or not you think that prices, demand are going to remain elevated enough in order for you to push further into the Barents, to push further into more hostile waters in terms of where that production comes from. How do you see that mix going forward? Do you think it is going to be strong enough? Where do you see the next fields coming from? Because in so many ways, Norway is an untapped energy source. It's just getting it out at sufficient cost levels to make it economic.
It's a good question, but, I think the key thing is we're very disciplined about the type of projects we do. We look to do projects with strong economics, $35 break even. So, oil and gas prices are well above that, and looking forward, we wouldn't expect them to be at that level. So, we'll only do a project if we have robust economics, and I think that's what Norway offers, a framework to allow us to do that and to invest into the business long term. And the key point I've learned through this industry is it's cyclical, and you have to invest for the long term, and you have to invest to be able to deal with the low cycles, and that's what we're doing.
So talking about investing in a disciplined way, Nick, you've made the Neptune acquisition that Guy was referencing. How are you going to shape your portfolio of assets on the back of that? Some of these are going to be more attractive than others. And does the push to remove perhaps some Chinese investment from the North Sea, does that open up other opportunities for you?
You know, Neptune was a fantastic deal for us because it had a very good fit for us. So we say it's the perfect fit for a company, and it's got a stable profile, which is pretty flat until 2030, and there's a good fit on assets. So it adds value, it's low capital, and it creates the ability to fund dividends and growth more sustainably for a company. And so as a business, we're now going to grow to 400,000 barrels a day by the end of 2025. And when you put the whole portfolio of Vår original portfolio and the existing Neptune portfolio together, we have a fantastic opportunity to continue to sustain our production at 350 to 400,000 barrels a day out to 2050 with the assets and opportunities that we have in our hands today. And we're going to invest in pace at doing that.
Can I ask you, thinking about investment, I wanted to just ask a broad question about your investment horizon for your business, for the sector as a whole. You've talked about investing into the growth in oil and gas that you see ahead, despite parts of the energy landscape transitioning away from that. So what kind of investment horizons are you thinking about at this point, Nick?
Yeah, no, it's a great question. And, you know, the type of, you know, we're present in all of the basins in Norway, and we're involved in half the fields in Norway and a lot of the infrastructure. So the type of opportunities that come forward are short tieback opportunities, subsea. These come with low cost, short cycle times, and typically they pay back in a couple of years. And so they're highly economic, and we've got a series of these to do, and we can increase the pace or slow it down depending on the outlook. So a lot of flexibility to invest depending on demand and on pricing as well.
Nick, it's Creedy in London. Talk to us a little bit about the appetite, or any appetite, for the LNG story. This is a largely expanding story coming out of the United States. There's, of course, need for it around the world, and you're seeing a lot of big oil and big energy companies, I should say, want more and more exposure. What is your view on that? Are you looking for similar exposure?
Well, most of the opportunity in Norway, you know, most of our production is oil, first of all, and then about 35% is gas. And most of the gas that comes out of Norway is piped gas into Europe. Of course, there is one LNG facility, which we're a shareholder in up in the Barents. And I would sense that probably going forward, it's more likely to be more piped gas, but you never know. And so I think that's the opportunity. And piped gas is generally cheaper than LNG facilities. So that's where I think Norway and Europe has a benefit with Norway being on the doorstep and being able to pipe gas into Europe.
The infrastructure in the United States, however, is expanding. So when you look at kind of the economies of scale, they are expected to come down over the next 5-10 years, given that kind of growth in the States. Does that, again, not appeal to you? Is it a cost concern when it comes to LNG?
Yeah, but, you know, there's a cost of running an LNG facility, and then there's the transportation, and that drives the marginal supply cost. And I think we can work within that and make economics work here in Norway. And that's the way we look at this. And, you know, this business is also cyclical, so there's highs and lows in this. And we look to the long term. So I think, I think there's a market for gas in Europe long term, and we're going to be able to be cost competitive out of Norway.
Nick, you mentioned the transportation costs in particular. I'm curious, in light of some of the geopolitical tensions around the world, are you seeing a margin squeeze from increased transportation costs?
Well, of course, quite a lot has changed over the last few years as energy markets had to adapt to the challenges associated with Ukraine. And, of course, that's put cost onto the transportation costs. But you know, for us, it doesn't really impact us. I mean, all our gas goes in pipes. Most of it goes in pipes to Europe, and we ship all our oil into refiners in Europe, so that's short distances. So actually, we're advantaged, I think, to some extent in this respect.
Nick, what do you think European majors, European oil companies, European energy companies need to do to get onto similar multiples that we see over in the United States?
You know, I think it's an interesting question, and not I think for us, we're focused on delivering our business and creating maximum value out of our business. And we're a European-focused company and get the investments mostly from Europe, and we're looking at maximizing our valuation. And I think the trajectory that we've laid out today gives us an opportunity to grow value into the stock, because we can now demonstrate sustained value creation over a long period of time. And I don't pay much attention to thinking about how the majors or how you get value multiples from the US.
Nick, thanks so much for joining us. Good to speak to you. Nick Walker, the CEO of VAR Energy, with thoughts on the energy sector. Coming up on the programme, forget the artificial intelligence frenzy. A new short volatility trade is booming. We'll bring you that story next. This is Bloomberg.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted, and I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
We have seen a bit of softness in economic data coming out of the U.S., and that has bolstered the case for rate cut expectations. So I think, looking at alternative assets as a way to hedge out your risk, given the fact that equities are trading at all-time highs, is one way we would, try to hedge those extreme risks in the market.
Anika Gupta, Director of Macroeconomic Research over at Wisdom Tree, talking about how you hedge risk. And one of the most popular trades of doing that is betting against some of the market turmoil, one of the measures, is 30 times larger than when it blew up the market 6 years ago. We, of course, are talking about the short vol trade. I want to dive into it a little bit more. Bloomberg's Justina Lee joins us on set. Justina, before we dive into the nitty-gritty of this, I need to throw some numbers at you and our audience, because this kind of factoid was brought to my attention here. When you look at the S&P 500 options volume, 50% of it is made up of just same-day options. This idea of zero-dated options kind of feeding into the short vol trade. And more people are talking about kind of this PTSD, or this 2.0 of Volmageddon that we saw in 2018, where all of a sudden things were looking great, the markets were great, and it all turned very, very quickly in that fourth quarter of 2018 due to macroeconomic factors, fund flows, tariff war, but also this vol trade that could blow up. Walk us through the possibility of that happening again.
Yeah, I mean, if we kind of go back to basics, I mean, what is a short vol trade, right? Because we always think of options market as buying market insurance. And short vol is sort of the opposite of that, where you're selling insurance, where you're collecting these premiums. And right now, because not a lot kind of has happened to really blow up the market, a lot of people have been trying to collect this income from selling options. But then the problem is, you know, as soon as the market turns against them, I mean, suddenly, you know, you're losing money. And so there will be a lot of people unwinding those trades. And that's the risk that a lot of people are worried about.
So you're talking about betting on enduring calm in equity markets, if calm is defined as just going in one direction and not, you know, not being volatile. So you're betting on stocks going up again. Give us a sense of the size of the bets that we're seeing here, the scale of this positioning.
Yeah, we're really talking about multiples larger than pre-2018. And the reason for that is that there kind of been an explosion in popularity of these option income ETFs, where they might buy something underlying, you know, like the S&P 500, but they're also at the same time selling options, so that you can also get some income on the side. And that's one kind of spin that makes it potentially a bit safer, because at least you have that underlying. But then I think, like, for a lot of investors that have kind of just seen markets like slowly crawl up over the last few years, I mean, it can still be a pretty big shock.
You mentioned the underlying. That's the concern, right? That's going to kind of bleed into the S&P 500, even though they're talking about a completely different market in derivatives. What stops that from happening?
Yeah, I think, like, you know, actually for a while, the options have kind of been helpful in the sense that this is really complicated. I'm not going to mention the option Greeks, but like the market makers have been like hedging their positions, and it actually tends to have a calming effect. Yeah. And so that's kind of been helpful. And of course, there's underlying kind of the underlying investment in the S&P 500. So you're not just kind of like shorting vol unhedged. Yeah. But I think what kind of the markets are really kind of waiting for is whether you're going to get a big like exogenous shock. And I think that would be a big surprise to a lot of punters.
Let's walk through that scenario, because the skew's interesting here, isn't it? There's a lot of calls, but not a lot of puts in the market right now. So basically the market's given up buying puts as protection, because you're basically just giving the premium away. If you do see, and we haven't seen a big move for a long, long time. I think the last big move, 2%, was to the upside. We haven't seen a 2% downside move for a long time. But say you get 2-3% on the downside, the CTAs are forced to chase it. The market's unhedged. Walk me through how quickly that story could get negative, because you mentioned the Greeks, and I'm wondering if everybody suddenly starts buying downside protection, you've got the gamma, the negative gamma that then comes in as well. How quickly could this reverse, and on what sort of scale could it reverse?
Yeah, I mean, if we get a really big downside move, a lot of the time the market makers go into the opposite direction, and they have to chase the move as well. And I think a lot of retail investors are going to be burned out of these short vol trades. They might not do that anymore. They'll be unwinding their losses as well. But it's exactly like you said, where over the last few years, I think a lot of investors have become a lot more reluctant to buy market insurance, because they don't want to keep paying those premiums. And they're counting on like their hedge funds or kind of like other allocations to hedge that risk.
So we're 6 years since the so-called Volmageddon. We're describing this as the cousin of a potential Volmageddon, Justina. How would you assess the risks of it happening again?
I think for now it is not as massive. Like, these bets are kind of structured in a way that is kind of less risky than before. But I think, you know, there's still kind of a big potential for surprise here, because I think a lot of people are... I was kind of talking to someone yesterday, and they were saying, you know, you used to be afraid of a market sell-off. Now you're afraid of kind of like missing out on any upside. And so I think a lot of investors have learned to stay invested in equities no matter what. And so I think it would be a big shock if we kind of get more signs of a recessionary risk or any more like serious geopolitical flare-ups.
You mentioned the retail contribution of that as well. I'm throwing you another factoid at you because I just picked the mind of our Bloomberg Intelligence folks on this volatility story. They sent me a million little pieces. And they said that of the zero-data options market specifically, which is where a lot of people are piling into, 40% of that is retail-driven. And that's not normal. Usually it's much, much more than that when the retail function. The fact that more institutional money is kind of going in on this trade, is that similar to the idea, and you're a cross-asset reporter, you know this well, is it similar to the idea you're seeing in the bond market where more and more people are on the front end of the curve? Is that the same thinking there?
Well, I think that a lot of people really love these zero DTE options because to retail, it's kind of a pretty intuitive way to bet on the market direction. And for a lot of institutions, it's a very useful way to hedge whatever market risk is coming that day. Like if it's a specific event like the Fed meeting or something, it's a good way to hedge. And I think it's kind of really interesting because we used to think of options as this like really nerdy part of the market. And now it's kind of exploded into this thing where there's like kind of a lot of mainstream adoption. And we also used to think of options as mostly a market for hedging, but kind of like Guy was saying, I mean, right now, a lot of people are buying calls, you know, like a lot of those can be even more expensive for the puts because people are buying those to bet on more upside in NVIDIA or Tesla.
In terms of the profitability around this, can you just give us a sense of the scale? Like I said a moment ago that this was the best performing strategy last year. How much money is being made here? We often look at the stock market and think of NVIDIA. We think of the cash kind of story and think about how much money is being made. How does this trade relate to what we're seeing in terms of relative other asset classes?
I mean, by one measure of just kind of, I guess, a more systematic short vol trade, I mean, that made 9% last year. And so it's pretty good kind of by professional standards. But I mean, I think for a lot of retail investors, if you're buying S&P, but taking some of that to sell options for income, it's actually hasn't been as good as holding the S&P outright. But I think a lot of people kind of like the idea of like getting a bit of income kind of every now and then. The yields look really high. Yeah. But of course, like any other markets, the more you sell, kind of the less attractive it becomes.
But we talk about a stock market crash. Would a vol crash be as big an event? The two are going to be connected clearly, but in terms of the impact that it could have, how big a systemic risk could this be?
I don't want to say it's a systemic risk just yet. And it's true that, I mean, the VIX has just been going lower and lower. It's been a bit higher lately, but the VIX going lower does tell you their selling vol is actually not as attractive as before. But I think a lot of people are still drawn to it, and they're not kind of looking at it that way.
So not a systemic risk yet, but then if you kind of look at what people are talking about, they're saying if there is some sort of bigger correction or bear market, options are going to be the scene of the crime and where it kind of starts from and then begins to spread. Justina Lee, we thank you so much for walking us through a very complicated and nerdy story, but we appreciated it. We need to flush that out.
Excellent. We also need to keep a close eye on what's moving in these markets today. And the retail sector is of a different nature. I mean, the companies that do retailing as their business, those stocks doing pretty well today. And Zalando is the best of those, up by 12%. But we also see Inditex doing well, up by 4%. The story around Zalando is a positive one, beating on adjusted EBIT, updating their targets. RBC analysts saying they're confident that this German business has the ability to capture growth as the consumer demand recovers. And that's the big question hanging over the sector, I suppose, in Europe.
Adidas is down, which I think is interesting this morning. In some ways, there is some signs of stability, but it appears it's the lack of guidance that is causing the concern.
And some people, because they had this number out in January that disappointed the markets. And then, as we were hearing from Deirdre earlier, somebody now leading the business who has a habit of maybe being a bit cautious on the guidance, but there had been some expectation that maybe it'd be up today, and it wasn't. And so, as a result, maybe a little bit of...
Which one of those? It's Sambas or Gazelles?
Have you figured out during the course of the show? Do you have a preference now?
Not really, but Justina had them on. Clearly there is a trend. I think she's pretty.
The cool people
pretty
are
on the
wearing them. Yeah, absolutely.
Which basically explains
Thank you. Thanks for telling us, Chris.
It's not me. I'm not included in this.
No. Well, yeah. Anyway, let's tell you what else is coming up today. We have a bit of data, lots of bond market auctions. I seem to remember last time we did the daybook, that was one of the things that stood out. But Euro area industrial production, 10:30 London time. We get a 10-year Bund auction out of Germany. We get an auction out of the US later on, 30-year, which will be interesting, as Guy said, after the 10-year that we got yesterday. I think they'll continue the conversations around the Fed in the next hour. That's going to be something to
Randy
watch.
Croser's joining Tom McKenzie on the Pulse next. He'll have a great view on what is happening in the CPI story.
Yeah.
He's obviously got some insights, having had a seat on the FOMC. That's coming up. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
You never hear people saying, I want my little boy to grow up to be an insurance person. Did your parents tell you to be in the insurance world?
I really liked the insurance sector at the time. We are basically promoting and ensuring social cohesion. And at the time, I wanted to make a difference and wanted to go in there.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Tom McKenzie in London with the conversations that matter. Here's what's coming up on today's programme. Stocks struggled to maintain momentum after another record-breaking session on Wall Street as investors shrugged off hotter than expected US inflation. The world's largest car maker, Toyota, agrees to wage hike demands from unions, adding to the case for a BOJ policy shift next week. Plus, the UK economy rebounds in January with modest growth after slipping into recession in the second half of last year. Let's check in on these markets then. As we said in the headlines, records again coming through for the US yesterday and European stocks. A bit of a different picture so far in the session, a bit of a breather, maybe a bit of profit taking as we wait for the next catalyst. And yes, equity markets in the US were able to charge through and look past that stickier inflation print that came through in terms of the CPI. Currently on the UK, the FTSE 100 is flat. Yes, we are back in growth territory. It seems modest growth, 0.2% for the month of January. But of course, a change of direction given the contraction we saw in December, 0.1%. We are setting ourselves up for a first quarter of growth here in the UK, it seems. Over in France, the CAC 40 is up 0.2%. The Spanish IBEX performing relatively well, up 1% as things stand. The FTSE MIB over in Italy, of course, up 0.2%. In terms of the sector-by-sector breakdown, it's retail retailers and utilities coming in through with some of the strength as healthcare disappoints. Let's flip the board and have a look then at US futures before we go cross-asset and dive through some of the currencies and fixed income. Then S&P futures currently flat again after the fresh records that were broken yesterday. NASDAQ futures 18,455, pointing lower by 21 points. Again, it was Oracle and Nvidia that led the charge yesterday. Nvidia notching up another 7% gain in the pricing yesterday. The European futures, or at least the European session so far, as I said, flat at 506. Again, after the records that were broken yesterday across European stocks. Let's go cross-asset then, have a little look again at what's happening with some of the currencies. The pound, of course, in focus for us today on the back of that data, but also the Japanese yen. Given that we did have this wage agreement coming through from Toyota, again, the biggest car maker, of course, globally, and they have agreed to the demands from one of the key unions around wages and around bonuses. So that is leading to expectations continuing to fuel the view from some, at least, that the BOJ does have now space to raise interest rates next week for the first time since 2007. They're still waiting on that full picture that should come through on Friday from one of the main unions in terms of those wage negotiations before they make a clear call. That is the Bloomberg reporting. The pound, currently you're looking at a little bit of movement when it comes to the pound. We're weighing up, of course, the wage data that came out yesterday, 127 on the pound versus the US dollar, and not a huge amount of movement in gilts. Yields up just 1 basis point currently on the UK 10-year. The Japanese yen currently at 147, just down 0.1%. Bitcoin continues to be in focus for us today at 73,455, breaking through that 73,000 level. Of course, the inflows into the ETFs and then expectations around a potential halving in April, capping the number of Bitcoins in supply. So we'll keep across that story for you as well. But let's get back to the inflation prints out of the US and what it tells us about thinking from the Federal Reserve. Underlying US inflation then topping forecasts, as I mentioned, of course, for a second month in February. The advance likely to reinforce the Fed's cautious approach to cutting rates. Very pleased to say, joining me now is Randy Krosner, former Fed governor and professor of economics at University of Chicago's Booth School of Business. Randy, great to have you in the studio to digest this number. Sure. What stood out to you? Is this a sticky inflation print that we're seeing in the US, or is it a more entrenched inflationary picture that causes potentially a challenge for this Federal Reserve?
And that's exactly what the Fed is trying to pull apart, and that's why Jay Powell said he wanted to see a little bit more data before coming to a definitive conclusion of when they can move. Now, they usually focus on the so-called personal consumption expenditure index, not the CPI. The PCE is a little bit better balanced in terms of the role of mortgages, or I should say the role of different parts of the consumer basket, and so they prefer that one. But this still is suggestive, and I think will give people pause. Certainly, no one's, I think, going to be moving in the next week, but they may leave the foundation for a move in June.
Okay, before we get on to your views on where they land and the sequencing, you say it's possibly June. In terms of unpacking the basket of inflation that we got through yesterday, with all the context, as you say, that the focus is really going to be on PCE for the Fed, we did see goods inflation ticking up a little bit. That seemed to be something of a surprise. Do you expect that to be short-lived, or is that indicative of a more concerning trend?
So I think the goods are going to be more volatile because that's going to be more energy and commodity prices that sort of move up more up and down. And so that's why they tend to look at core that strips that out. But we're still seeing fairly strong growth in services. And in particular, still strong wage growth. Now, that's great for workers, but more of a challenge for the Fed.
And you mentioned Jay Powell, and he said, of course, in testimony last week that we are getting closer. He wants more confidence. Him and the FOMC, they want more confidence in terms of the data that they're seeing before they act, before they cut rates. But he says we are getting close. I just wonder if there's a concern that he may have to walk that back. It seemed to be relatively dovish from Jay Powell. Are you concerned that he may have to walk that back, given what we're seeing on the data front?
Well, so far, I don't think there's enough data there to say that he's going to have to walk that back. But he's made it very clear he needs to see more data before moving. And so if the data don't move in his direction, I think he doesn't have to walk anything back. He can just say, we haven't seen the data yet to be able to make that move.
Okay. We're looking, of course, for the forecast, the updated forecast from the Federal Reserve, or the dot plots and the potential revisions there. The markets, of course, have gone from the start of this year pricing at about 7 cuts to a little over 3 right now. How do you expect the revisions to the dot plots to evolve? What are you expecting to see from that?
So I don't think we're going to see dramatic revision to the dot plots. I think the markets have finally gotten it. I thought it was just sort of crazy that they were thinking that there are going to be so many cuts at the beginning of the year, and I think the Fed has been fairly consistent in their message, and finally the markets are starting to move to be roughly where they are. I don't see that the data has changed so much that would dramatically change the dot plots. I think 3 seems to be roughly right. The question is, will they start in June or maybe start a little bit later?
Okay, so 3 seems relatively reasonable. Where are you in terms of your views on the US economy? Jamie Dimon, a big line crossing this week when he said, look, we shouldn't write off the risks of a recession. It is still potentially in the cards for the US, after almost kind of consensus view amongst the guests we speak to that soft landing is there now for the US. Where do you land on this debate?
Where do I land? So, there's soft landing, hard landing, softish landing. I'm kind of hardish landing. Okay. That is that I do think that there'll be a substantial slowdown in the second half of the year. Now, why is that? Because real interest rates have finally gotten positive for the first time in 20 years. They've only been positive for about 6 months. That is, the interest rate, the 5% or so interest rate, has been above the inflation rate only for about 6 months. Real wages are finally starting to be to grow in a positive way. Now, remember, when prices were going up at like 8%, you could sell stuff at 8%. Your main input cost was going up at 3 or 4%. That's a great trade. You're going to buy a lot of that input. When real wages start to grow up a little bit more, and you're not being able to sell at quite the same pace or same pace of price increases, you may start to see a little bit of weakness in the labor market. I'm not calling for recession, but I think a slowdown from where we are. We've been just having screaming growth in the U.S. I don't see how that's going to quite keep in the second half of the year.
That pricing power then ties into the story around equities and around what we're seeing in terms of stocks. Does that suggest that stocks are getting a bit ahead of themselves then? If you see a more challenging picture in the second half, does this rally in U.S. stocks look a little unsustainable to you?
Well, I'm usually not in the business of predicting the exact level of the stock market, but I do think that markets seem to be kind of priced to perfection. They seem to be thinking that, soft landing or no landing at all. We're going to continue to have really strong earnings growth. I'm a little bit more concerned that there could be some challenges to that.
You've been also thinking, I know, in great detail about the proposals around additional capital reserves for the US banking system. And this also caused some surprise and certainly generated headlines when Jay Powell suggested that the proposals would be either radically revised, rewritten, or potentially scrapped altogether. You've been thinking about the potential risks of this proposal. Give us the detail on why you think actually the proposals, if they were to come into force, they could actually cause more risk for this financial system versus reducing the risk.
Yeah, because I don't think there's been a really careful cost-benefit analysis that's done. Certainly you want to make the banking system safe, but you also want to make the entire financial system safe. So if you keep raising capital requirements, what happens? More and more activity goes outside of the banking system. And we've been seeing that, whether it's private equity coming in and doing private debt, so many other areas that you're seeing a lot of stuff going off into the so-called shadows. There's potentially more risk there because the regulators as well as market participants don't have as much line of sight. And that's where you could potentially get these unintended consequences of, sure, you're trying to make the bank safer, but you could maybe make the entire system a little bit more risky.
Is that where the regulatory lens needs to be then, on the off-balance sheet banking sector, the shadow banking? And how concerned are you that potentially there's a black swan event there?
So I think that's where we really need to have a stronger line of sight. We need to do more data gathering there. We need to have better understanding of the risks of interlinkages amongst those non-banks as well as between the non-bank sector and the banking sector. I think that's really where we need to have a lot more focus.
Okay, Randy Cronson, we're going to get your views on the Bank of Japan as well, the ECB as well, in more detail just in the next couple of minutes. Very pleased to say Randy Cronson, the former Fed governor and professor, of course, of economics at the University of Chicago, will give his analysis and his views on some of the other central banks making waves, of course, today and throughout this week. That is in the next couple of minutes. Let's take a look now at some of the other top stories on the terminal right now. And the election rematch is on. Not a big surprise. We knew this was coming. Donald Trump and Joe Biden securing enough delegates to win their party's nominations, setting up then a rerun of the 2020 US presidential election. It comes after both passed the delegate thresholds to clinch their party's nominations for the election in November. The nominations will be made official at party conventions this summer. Now, the first ship carrying aid to Gaza from Cyprus has set sail. Is the first shipment as part of a new marine corridor announced last week. Under the plan, ships will carry food and medical supplies from the Cypriot town of Larnaca across the Mediterranean Sea to Gaza, where the US plans to set up a temporary port to receive shipments. It comes as Israel plans an assault on Rafah, the last major city in the enclave where residents are sheltering. The European Union is on the verge of enacting comprehensive guardrails on the fast-developing world of artificial intelligence. The bloc's parliament will vote today on the AI Act, a landmark set of rules that could set the tone for how AI is governed in the West. But the legislation's likely passage comes as companies worry the law goes too far, while digital watchdogs say it doesn't go far enough. Coming up, the yen strengthens as the world's largest car maker, Toyota, agrees to wage hike demands from unions, adding to the case for a BOJ policy shift next week. We'll get Randy Krosner's views on whether or not the markets, global markets, face risks from this potential shift in the BOJ. That is next. This is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back. Now, expectations are rising for the BOJ to move on rates after Toyota confirms it will meet its labour union's demands for wage hikes in full. Toyota, of course, the world's biggest car maker, a major employer in Japan. So that's consequential. Let's bring back in Randy Krosner then, former Fed governor, of course, and professor of economics at the University of Chicago's Booth School of Business, and obviously a fantastic person to have on to talk all things Fed, BOJ, and ECB. Randy, I was speaking to a former BOJ official yesterday, and he said the likelihood for him of the BOJ going next week with a rate hike, the first one since 2007, he put that at 70%, and he also suggested they could also drop yield curve control. Where do you think the BOJ goes next week? Do you think they've seen enough to give them the confidence to make this move?
So I think Ueda-san wants to go very, very gradually, and I think that's the kind of mantra that he's had so far. They're facing a lot of challenges because, obviously, as you said, there's very strong wage growth, not only at Toyota, but a number of the other wage settlements have been very, very strong. But they're also in a period of very low GDP growth, and also inflation expectations haven't quite moved up to the 2% area where they want them to be. So I think they'll move cautiously. There may be some slight moves in the direction of move up next week, but I think it's more that they're going to provide the foundation for moving down the line. But I think they need to see a little bit more to make sure that consumption is still going to be strong and inflation expectations move up.
And when you say down the line, you think April, or do you think they could even push it further back?
I think they'll depend. I mean, if we're seeing some weak economic numbers overall. If those turn around, then I think they'll move more rapidly. If those are still quite weak and we still don't see inflation expectations moving up, it could be a little bit later. But I think there'll be gradual moves in each of these steps in that direction.
Okay, cautious, gradual, the timing still TBD. Are global markets ready for this shift from the Bank of Japan? What do you expect to see in terms of the global market ramifications of this move?
Now, this is something that's very important. Japan is a very big place, and Japan has a lot of debt outstanding. And so obviously as interest rates go up there's going to be more flow back to Japan. Most major countries of the world are issuing a lot of debt, and so there's going to be a lot of competition for who's going to buy which debt. So far, the bond vigilantes haven't come back out. They seem to be happy to say, oh, lots of debt, no problem. At some point, they will rise up. I hope it doesn't come too suddenly, but at some point they'll come back, and that's going to be a problem.
Has that surprised you, that the bond vigilantes have so far stood on the sidelines? And what do you think would be the trigger then for that intervention?
That's always the key. We never know exactly what triggers it. Something changes people's confidence. And look at countries like Argentina. They kind of go along very well for a while, and then boom, suddenly something happens and people get very worried. Is the rest of the world like Argentina? No, but you worry that there could be some sort of triggering event that make people say, gosh, I'm not so sure they're going to be repaying, or I'm not so sure they're going to have the economic growth to be able to make those payments.
On the ECB, a couple of dovish comments today suggesting maybe from the Bank of Governor over in France, and another central bank governor who sits, of course, on the ECB Governing Council, suggesting that possibly April, possibly June. There's a debate as to whether ECB has to wait for the Fed to go first. Is the ECB, though, given the dynamics in terms of softer inflation versus the US and a much weaker economy than the US, is the ECB at risk of a policy mistake?
So I think they have much more pressure to move more rapidly because, exactly as you said, much weaker economy, and the U.S. economy is still quite strong. And so I think they're going to get pressure to move more rapidly. But I think they are looking very much at what the Fed is going to do. And so I think how the Fed characterizes what their next move is going to be, because my guess is the Fed's statement next week, they're not going to say they're going to move, but they're probably going to say they'll move soon, leaving the foundation for moving in June or next move in the summertime.
Okay, the gravitational pull of the Fed, always.
Yes.
Randy Krosner, thank you very much indeed for the analysis of coming on, of course, into the studio to walk through that CPI print, the implications for the Fed, and of course, where the BOJ and the ECB could go as well as they weigh up their own challenges. Randy Krosner, former Fed governor, of course, and professor of economics at the University of Chicago. Coming up, Volkswagen has said it expects its slew of new models to drive sales in Europe, but how will the German car maker reinvigorate EV demand? And which of those factors are in VW's control to change? We discuss that next. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
You never hear people saying, I want my little boy to grow up to be an insurance person. Did your parents tell you to be in the insurance world?
I really liked the insurance sector at the time. We are basically promoting and ensuring social cohesion. And at the time, I wanted to make a difference and wanted to go in there.
DOJ or other authorities
could face bigger challenges next.
Was going to keep winning World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Now, Volkswagen expects orders in Western Europe to pick up in the coming months as updates to popular models are rolled out. The German car maker has a pipeline of more than 30 new products this year and is looking to boost momentum into the shift to EVs. Here's what CFO Arno Antlitz said on VW's outlook.
2024 will be a challenging year. We have macroeconomic environment is like uncertain. We have interest rates still high. On inflation on the cost side, and there's a lot of competition in the BEV markets. But there are also positives. The market will grow slightly, and we bring some great new models specifically.
OK, let's cross over to the man who actually spoke to Arno Antlitz earlier, himself, Bloomberg's Oliver Crook, of course. Ollie, what else did the CFO have to say about the outlook?
Yeah, it's really interesting to look at where Volkswagen is in its sort of trajectory now, because you remember this event 1 year ago is where they announced that behemoth of a spending plan, 180 billion euros that they were going to put in to really catch up on the battery electric vehicle transition, dealing with all the software. And that was, again, you know, a year ago. And today, it's all about execution. That was a reorganizational year. This is the year of execution. As you heard from Arno Antlitz, this is going to be a tough year. And they're not shy about saying that to investors right now. This is also going to be the year where they peak in terms of cash burning. And as you say, you know, they've put out 30 new models that are going to hit the streets this year. And what's interesting is that 30 models across combustion engines, hybrids, and battery electric vehicles. So they're at a moment now where they have a three-pronged approach, which is going to cost a lot of money. And they're hoping for that to kind of like focus a little bit further into the future. Next year, they're going to start that ramp up. And then 2026 is really when they hope that will deliver by. The question is for investors, is that timeline good enough? We heard similar things from Porsche yesterday. Investors were clearly convinced there because it had its best day on record, up 11%. But the question for Volkswagen is not Porsche.
Yeah, well, indeed. What do they have to say about the crucial market in China then, Ollie?
What I found very interesting in the numbers that we had here is there was actually very little about China, which, as you know, Tom, is sort of conspicuous given that it is the biggest market that you have for Volkswagen in all of their portfolio. And last year, sales in China rose only 2%, and that's versus 20% for Europe and North America. So I asked Arno Antlitz what their strategy is there and what does it look like going forward.
We are deliberately prepared to give up market share in the next, I would say, 1 to 2 years, 2024, 2025, in order to find a sound compromise between margins and volume. But from 2026 onwards, we want to regain share also in the BEV segment.
So it's interesting, the CFO there saying basically they're willing to give up market share for a couple of years, which is kind of a risky strategy. They may not have much of a choice because it's much harder to gain back market share than to defend it. In terms of the bright spot, where is the growth going to come from if not China? They said the United States.
Really interesting line there from the CFO. Oliver Crook, of course, in the ground in Berlin. Thank you. Coming up, we're going to be speaking to Gershon Distenfeld, Director of Income Strategies at Allianz Bernstein. That is next. How to position in these fixed income markets. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stocks struggled to maintain momentum after another record-breaking session on Wall Street as investors shrugged off hotter than expected US inflation. The world's largest car maker, Toyota, agrees to wage hike demands from unions, adding to the case for a BOJ policy shift next week. Plus, the UK economy rebounds in January with modest growth after slipping into recession in the second half of last year. Good morning and welcome to The Pulse. I'm Tom McKenzie in London. Let's check in on these markets then. Yes, fresh records across Wall Street yesterday, driven by the likes of Oracle and Nvidia. Also, the highs coming through for European stocks, fresh records there as well. Different picture today, a bit of a breather coming through. US futures then, S&P futures flat currently, still above that 5,200 level. NASDAQ futures pointing lower by just 0.1%. And here in Europe, you're seeing very modest gains of about 0.2%. Retail as a sector is leading the gains, up 2.6%. On the downside, autos off by 0.4%. Now, bond prices slumped yesterday after the US Treasury's monthly 10-year note auction drew weak demand. This is despite the fact that yields rising into the bidding deadline off the back of inflation data that exceeded expectations. For more on this, I'm joined by Gershon Distenfeld, the Director of Income Strategies at AllianceBernstein. Gershon, great to have you in the studio. You're not too concerned. Medium term, you think the inflation story holds up in the US, the downside keeps coming.
Yeah, so, we're back to the kind of bad news is good news as we saw the equity markets rally on what was a higher than expected print. I would note, I'm usually not a big fan of going into the hundreds or thousands of decimal place, but the print was 0.358, which rounds to 0.4. So interestingly, had it been 100% lower, it would have been 0.3 and people wouldn't have been as concerned. But look, inflation is still too high as far as the Fed's concerned. And there's going to be no sense of urgency now to cut rates. I think, March has been off the table for a while. Probably May's even off the table. We're still expecting the first cut around June. But what's most important is actually not when the Fed starts cutting. It's how much, how deep, how fast, why they're cutting. Those are things we have to look for in the coming weeks.
Talk to us about that. If they're in no rush to move, given the relative stickiness of this data, how does that inform the dot plot and the forecast that we expect to get?
Well, the dot plot's going to continuously change. The market was pricing in 6 cuts as recently as a month ago, and now is pricing in about 3. Now, of course, that doesn't mean the market's predicting 3 at this point. That's an average of everything that could happen. In fact, I think it's more binary. If inflation is sticky, the Fed might not cut at all this year. I know that's crazy, and I think the markets would not be thrilled about that. But
that's not your base case.
That's not our base case. Our base case is they're going to start to cut. But, they might cut much harder than you think. This has been almost, it's an overused phrase, a Goldilocks scenario. You've actually had the soft landing. We studied, the news media used the word soft landing very often before every single recession in the past 30 or 40 years. This time it actually may be happening. Now, we don't know, right? It's not just the level of rates, it's the time, right? And rates have been elevated for quite some time at these levels. So the longer that goes on, the more the chance that something breaks and that, of course, growth slows.
Randy Krosner telling us just in the last 15 minutes or so, he thinks there's going to be a harder landing in the second half. He's concerned about what's happening in terms of wages and the squeeze potentially on corporate profits. You seem to be pushing back on the Goldilocks scenario, the soft landing scenario. Is a recession part of the forecast for you? Do you at least have to calculate around that risk?
I think you have to put some percent on it. You know, maybe for us it's 10 or 20% on a hard landing. We're gonna have to see. You know, it's been, like I said, it's been very, very, it's been very easy so far. But economic weakness can come in very, very fast. And look, the Fed is, what they're really mindful of, they haven't talked about it recently, but a year ago what Chair Powell was talking about was, you didn't want to make the mistake of the 1970s, right? The 1970s, they declared the war on inflation over, they started to cut rates, and then inflation spiked, and they had to raise rates to close to 20%. Now, I don't think that's in the cards right now, something like that, but they're trying to balance that. And so far, I think you have to give them, you can't give them anything but an A+ in how they've done so far.
What is the market vulnerability then? They get an A+ from you, the Federal Reserve. What is the market vulnerability if they cut later than June then? How vulnerable is this market to that cut being pushed back?
Well, I think you're going to see a lot of volatility because of it. Again, as I said,
at the front end,
you're going to see a lot of volatility at the front end and at the long end also. Look, I look at the long end and I see, like, if the Fed says they're going to try and get to 2% inflation, they're admitting probably 2% long term is going to be hard. There's some secular pressures, deglobalization, rise of populism being a couple. That's going to probably, in our view, going to mean that inflation is going to be closer to 2.5% long term. But you know, real rates have averaged 175, 200 basis points over the past 100 years. So I look at, you know, a 10-year or 30-year in kind of the low fours, and I don't see that as mispriced in either direction.
Talking about credit spreads, they're tight. Does that worry you? Does that close off the opportunities? Does that tightness continue in this environment?
Well, you know, tight spreads are the norm. You know, medians are quite a bit lower than averages. When they blow out, they tend to skew the averages. So spreads can stay tight for a very long time. Look, a year ago, I was sitting here and pounding the table, credit is cheap. I don't think that's the case anymore. I also don't think it's going to be a disaster by any means. You know, absolute yields are still high. You know, defaults are going to go up, but that's really priced into the market already. You know, there are a lot of, especially the lower quality bonds in the U.S. are priced at 50, 60, 70 cents on the dollar. When those default, doesn't necessarily impact the market. I remind people, you know, everyone thinks that 2008 was such a big default year. 2008 had less than 2% defaults. We know high yield was down 30%. It was 2009 where all the defaults came, yet you had 60% returns. So there's a huge lag effect, and we do expect defaults to go up, but that doesn't mean returns are going to suffer all that much, if at all.
So where along the risk spectrum in credit do you want to be sitting right now?
We want to be in the higher quality part of high yield. If you look at the sweet spot of credit in general, tends to be triple Bs and double Bs, so the lowest part of investment grade, the highest part of high yield. And that's because the market's very segmented. You know, that line between high yield and investment grade is actually artificial. It was created by rating agencies and insurance companies, you know, many decades ago. But the mentality of those investors are very different. In investment grade, you know, people feel like no one's going to fire me if I buy the debt of Walmart in my portfolio. But if I buy some cuspy triple B energy company and gets downgraded, I have to sell it at a depressed price, right? That's going to get me in trouble. High yield is exactly the opposite. People are what I call yield hogs. They want to get as much yield in the portfolio as possible. So that actually means you look at, by far, and it's pretty consistent over the 40-plus years we have of data, triple Bs and double Bs have by far the best Sharpe ratios out there. In fact, you know, triple Cs, for example, they don't return any more than double Bs over time with twice the volatility. We have a name for them. You're familiar with the term fallen angels, as we all are. Investment grade companies that used to be, investment grade companies that got downgraded to high yield. We call original issue triple Cs born devils. You only want to buy those when they've gotten beaten up and their prices are depressed.
Okay, so you're steering clear of the triple Cs for now.
We're very, very, very cautious.
Are you getting the yields you want to get in Europe?
Yeah, you know, it's interesting. As a U.S. investor, when you hedge back to dollars, you pick up a couple hundred basis points. So the hedge yields are actually higher. And, you know, even though we do expect probably weaker growth or more slowing growth in Europe than in the U.S., credit quality tends to be better like for like. All else being equal, if you buy a bond at the same level in U.S. and Europe, almost certainly the European bond has a lower credit risk, lower default risk over time.
What are your favorite sectors within credit right now?
I don't think there's anything that we love particularly in credit. Like you said, spreads are tight. There's nothing that stands out as a big anomaly to us. I think the key right now is just to be very diversified and probably stay away from some of the problem credits. It's a credit by credit kind of decision. Nothing really stands out as overly cheap or overly expensive.
You have a view, and you see value in high yield versus in high yield versus equities. And you look at the S&P over the last 12 months, up 30%. How do you make that case that you want to get exposure to high yield versus equities, and what kind of portfolio shift would that look like for you?
Yeah, people don't like to make that comparison. They view an investment in high yield as taking up the risk in your bond portfolio. If you look at it more holistically, there's I think a more clever way to look at it, which is you can take some risk out of the equity side, and particularly after equities have rallied so much. One of my pet peeves, people talk about equities don't have duration. I think that's ridiculous. They're the longest duration asset class out there. They're perpetual, right? In theory, they should, an equity price should be the present value of all future cash flows. So we've actually we talk about the Fed a lot, short-term rates. Let's talk about long-term rates, right? Which is the best proxy we have for the long-term risk-free rate. Let's say the 30-year Treasury. We've gone from sub 2% a couple of years ago to over 4%. Yet, any other asset class with duration, quote unquote, would have sold off, and equities have rallied. So I'm not predicting you're going to have a disaster in equities. I don't know, but I do know that a 20 times multiple when you have a 4 and change percent long-term risk-free rate is very different than a 2%. And I think high yield can compete. Most equity strategists are telling you don't expect the 10 to 12% returns going forward. Expect more 6 to 8. High yield is going to be competitive with that. What is consistent, though, is high yield has about 60% of the volatility of equities and much lower drawdowns.
All right, making the case then for high yield credit versus equities in this environment. Gershon Dustenfeld, thank you very much indeed. Director, of course, of Income Strategies at Allianz Bernstein. Now, let's briefly check in on the markets for you right now. The European Stocks 50 hitting 5,000 points currently, up 0.4% so far in the session. We have had a few dovish comments from a couple of the ECB central bank officials suggesting that maybe the first cut could come potentially as soon as April, more likely in June. That from the central bank governor, of course, of France. But you're seeing the Euro Stocks 50 currently up 0.4%, breaking through 5,000. Across your sectors, retail, the strongest gainer across your sectors, up 2.5%. On the downside, autos down 0.5%. Coming up, can a return to vintage Adidas styles or Adidas styles help the brand reset? We're going to take a close look at those results. That is next. Nice pictures, guys. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Welcome back. Now, European retailers have delivered, well, a mixed set of earnings this morning. Adidas reported a higher full-year operating loss of 377 million euros. Meanwhile, Zara owner Inditex boosted dividends by 28%. After a record year, of course, for the owner of Zara. Let's get more then from Andrea Felsted from Bloomberg Opinion. Andrea, let's start with Adidas and the earnings that came through. It's been a struggle, obviously, for this company. A lot of legacy issues to work through. Of course, their exposure to the US rapper Yee and all that stuff, the inventory drawdown they need to work through, FX. What stood out to you from these earnings?
I actually thought the numbers were pretty good, actually. When you think a year ago, they were forecasting an up to 700 million loss for last year, and they've actually made almost 300 million in operating profits. So that's a big swing. I thought Inditex was pretty good. Zara still on a tear. Massimo Dutti, the quiet luxury favourite, also doing quite well. So not a bad morning.
Quiet luxury favourite, Massimo Dutti.
Yeah, very quiet luxury.
Okay, interesting. And the dividend. Talk to us about the dividend raise then, because that seems to stand out. The markets expected about half a euro. They got about €1.5 from Inditex. What is the outlook for this business?
Pretty good. I mean, they announced a big investment this morning, or 1.8 billion euros this year, regular capital expenditure, about the same amount over the next couple of years in logistics. Some of the initial reaction wasn't very favourable, but you know, they've got a lot of cash, and it's good to see them investing. They forecast further growth, so they're investing behind that growth.
And Zalando is the best performing stock across the European benchmark right now, up close to 13%. How have they, the investor reaction, clearly, a lot of enthusiasm. What are they doing right at Zalando?
They're trying to be a provider of web services for other brands, you know, e-com for other brands, which has had a bit of a mixed, record across the industry. But, you know, Next also has got this very successful platform business, is where it sells and provides services for other brands. M&S also selling other brands on its website. So it's trying to emulate that, and it seems to be a good reaction to it.
Yeah, investors certainly rewarding that stock right now. That company, the stock up 12.8% or thereabouts on Zalando. Andrea Felsted, thank you very much indeed. Of course, from Bloomberg Opinion on the retail space and the earnings that have crossed through. Now to a very, very important story. It's been reported out by the team here at Bloomberg. The UK's medicines regulator has seized nearly 900 fake Ozempic pens so far. That's as unscrupulous individuals try to capitalise on the weight loss frenzy with counterfeits that range from useless to actually potentially deadly. Let's take a closer look at what's been discovered then. The top pen in this image is the real Ozempic pen. The bottom one, an example of a fake product seized on a raid in the UK. Ashley Furlong has been writing about this story for Bloomberg. The investigation actually seen some of these fake Ozempic products. What do we know about what's been going on?
What we're seeing is quite significant numbers of pens being seized in the UK. They're coming from abroad. But I think if you look at it in the bigger scale of counterfeit medicines globally, obviously this is still, you know, just a drop in the ocean. But very concerning, as you know, if any of those pens potentially got to patients, you know, it could be potentially deadly as they contain insulin, many of them.
So how big a problem is this, and how is the UK's approach to tackling it different from, for example, their counterparts in Europe?
I think it was a significant problem, and the UK came down very quickly and very strongly on this. The UK Medicines Agency has a team within it that does criminal enforcement, and that team actually has been leading on this, on tracking down these fake Ozempic pens, and they believe that they've got over the worst of it. Obviously, globally, we still have to see more products are coming to market. Everyone wants to get into the weight loss game, and criminals are watching closely.
Who's making them? Where are they coming from? Where are they being sold? And is the UK finally on top of it, as you say?
So they're coming from abroad, and they're being stopped at the border. Obviously, we don't have the specific details of the criminal investigations. They can't really give us all those details. But they're not being produced necessarily in the UK, and it looks like most of them are being stopped. And there have been a few hospitalizations, I think, in the UK, but it seems like the regulator is being able to clamp down on it.
Is there a response? What are you hearing from Novo Nordisk, the maker, of course, of Ozempic, Wegovy? To what extent is there an obligation on them to take steps to combat this kind of issue?
They're taking this very seriously. Obviously, it's potentially very bad for their brand, and also they don't want patients to be harmed. So they are actually on the ground. They have private investigators actually searching for these pens as well, and then actually reporting it to authorities.
Okay, so they actually have private investigators doing some of the work as well. How big a problem, if we take a step back in terms of fake medicines, fake drugs globally, how big of an issue is this?
So this is pretty small in the big picture, but I think what it highlights is that this is, a growing issue of counterfeit and illegal medicines, coming through supply chains. And we've seen this increase over the past couple of years. So it's something that criminals are definitely catching on to.
Okay, Bloomberg's Ashley Furlan, thank you very much with that investigation into the fakes around Wegovy and Ozempic and what's being done to try and tackle it. Coming up, Boeing's crisis is spreading to top US airlines as delays in aircraft deliveries slows output. We look at how aviation is coping under not so friendly skies. That plus your other key corporate stories next. This is Bloomberg.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to some of the key corporate stories from across the Atlantic now, starting with Boeing, whose slowing output is said to be derailing the growth plans of the carriers that rely on its jets. Let's bring in Bloomberg's Charlie Wells for the detail. Charlie, can you map out then how the fallout from Boeing's January 737 MAX incident is spilling into the broader industry? It's not simple as Airbus filling the gap, is it?
Yeah, I mean, the planes are literally delayed, Tom. Yeah. And that is a problem for these airlines, which, kind of post-COVID, they'd really been hoping for that bounce. And this is really kind of throwing a spanner, as you guys say in this country, into the works there. And I mean, look, there was an industry conference put on by JP Morgan, and a lot of these CEOs of these airlines have had some pretty harsh words for Boeing. So Scott Kirby, CEO of United, said that, they've literally had to tell Boeing to stop making the 737 MAX 10s for them that they'd ordered. The CEO, Bob Jordan of Southwest, said that we all need Boeing to be better. And actually, Southwest isn't expecting to get any of those 737 MAX 7s that they ordered, and that's cutting into the airline's capacity. That means they've also had to slow hiring, so 50% fewer pilots, 60% fewer flight attendants. Wow. And so, yes, when you have that choice between two companies, when one goes down, it's really difficult.
Huge ramifications, indeed, that we're seeing ripple across the airline industry then, as how they adjust to this shortage of planes. Switching focus to the semiconductor space, and one notable standout from the session yesterday on Wall Street was NVIDIA. Shares up, close to 7%. After at least two sessions of downside, right, for the semiconductor, the AI chip maker. What is going on with NVIDIA? Was this the buy the dip trade, or is there something more fundamental at play?
Good question. I mean, there had been that concern about the rout. I mean, $172 billion knocked off your market capitalization is going to leave, people a little bit nervous. And I think there was that concern that, NVIDIA had gotten into overbought territory. I mean, compared to a year ago, that stock is up 300%. I mean, those are some really big numbers. And look, they were lifted, it seemed like, by tech. There was positive sentiment on tech yesterday. Oracle, as we talked about, had better than expected earnings. And interestingly, Wedbush analysts pointed out that Meta put out this blog post that said they were going to use thousands of NVIDIA chips in their generative AI infrastructure. That could have been a boost. But let's watch to see if this has momentum. We're getting Adobe results later this week, so that could kind of add some complexity to the story.
Okay, as ever, we have to keep an eye on what happens with NVIDIA for that broader look on the AI demand picture. So from chips to chocolate and cocoa. And this is a real story. It has implications, of course, for Côte d'Ivoire and other suppliers of cocoa. Prices increasing. There's not enough supply. What's going on here, and what are the impacts potentially across the chocolate industry?
Yeah, so futures contracts hit a record 7,000 intraday, which is, not great for someone like me who could literally boost chocolate demand across the globe single-handedly. But across the globe, this really is kind of a supply issue. And in seriousness, bad weather and sick trees are actually impacting the supply in places like Côte d'Ivoire that you mentioned, in Ghana, and that's actually kind of spilling over into chocolate makers. Companies like Hershey's, they're having to increase prices, shrink packages, which is not what you want ahead of Easter, and also use less cocoa in a lot of their products.
Wait, does Hershey's actually use any cocoa in their products?
Those are tough words. They certainly must.
Favorite chocolate bar? I'm going for Tony. Tony's, big fan of Tony's. The Dutch can make chocolate. Who knew?
Yeah, that's exactly right. I love it when you throw in a little bit of peanut butter. So any product that's got chocolate peanut butter.
This is a Reese's Pieces. This is a Reese's Pieces favorite coming from Charlie Wells. Charlie, thank you very much for walking us through some of the key corporate stories of the day and then landing on chocolate. We appreciate it. Charlie Wells, as ever, thank you. Let's take a closer look at some of the other stories on the terminal right now. Bloomberg learning that UBS has started cutting jobs at its Asia private banking division this week as a slump in profits weighs on the region's largest wealth manager. The firm is said to be cutting about 70 people, including relationship managers, mainly in Hong Kong and Singapore, through the end of March. One of the people said asking not to be identified, discussing a private matter. A spokeswoman for the bank declined to comment. One of the frontrunners to replace Standard Chartered CEO Bill Winters is leaving the bank as part of a broader management reshuffle. Simon Cooper has led the lender's corporate, commercial and institutional banking division for 8 years. According to a statement, Cooper is exiting to pursue other interests. Checking on your markets right now. European stocks currently up just a little over 0.1%, of course, busting through record highs yesterday. Wall Street also in a similar state yesterday. Fresh records on the S&P, currently a little bit flat when it comes to US futures. The pound in focus for us today on the back of the economic data that came in slightly stronger, 0.2% growth in January. The pound at 127. Brent getting a pop as well. Oil prices higher at 1% higher on Brent, and Bitcoin continues to grind higher, 73,000 on that major cryptocurrency. Surveillance is ahead. This is Bloomberg.
other thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Including Mike Gapin over at Bank of America, who said this: service inflation softened, goods surprised. You can take more comfort, basically, from the former than discomfort from the latter. Stuart Kaiser of Citi, though, said this, Anne-Marie, and I think he's right. We're still on a downtrend, but the risks around that story have clearly shifted over the last month, which is why we've been pushing out the timing of that first cut.
Right, and we also have to wait for PCE to come in, because this is what the Fed looks at when they have their forecast. We heard from Ellen Zentner over at Citi. She's now penciling 0.3% for PCE. When they get PPI later this week, they're then going to go back and properly make those forecasts. But PCE is coming March 29th, after the next Fed meeting. So what kind of clues are we going to get this week for the rest of the data from when after the next Fed meeting that can indicate what PCE comes in? And I think that's when people will have a little bit more conviction on where they think this inflation story is going.
We are light on data this morning, but heavy tomorrow morning, that's for sure. Lisa, retail sales, PPI, and jobless claims on deck.
And honestly, all of them are important. Retail sales are important because, frankly, when you look at some of the credit card spending data,
it's conflicted. Some are saying that you're accelerating, some are saying you're slowing down. Every bit of data is conflicted, so it's choose your own narrative time. And the narrative that people want to choose is stocks go up and bonds hang in there, and that's where the market's going.
And stocks went up big time in yesterday's session, biggest one-day pop in a month so far. That's the equity market story. Need to talk about what's happening down in Washington, D.C. There will be a vote today in the House on potentially, I stress potentially, either banning TikTok or pushing them to sell it.
Right, it's going to go either direction, but it looks like the House this morning, this afternoon, will vote yes on that bill. They need 2/3. They're bringing it up under suspension of rules, and then it goes to the Senate. This gets a little bit tricky. We're already hearing a lot of suspicion from some senators that there's parts of this bill they don't like. Does it give too much leeway to the president? What does this mean for other companies that can be in similar situations? So it's very fast right now, the momentum. That momentum may slow in the Senate. But the President of the United States says if it passes through both chambers, he's going to sign it.
Can you tell us what China said about this today? What's the pushback be?
Just a few hours ago, we heard from the Chinese Foreign Ministry, and they said the United States is bullying, and they said this is going to come back to bite them. Already, potentially, we could see this becoming a bigger geopolitical story and a tit-for-tat between Beijing and Washington.
You have to admire the blatant hypocrisy of China's position on this. Meta can't get in the country. Google tried and failed. Twitter, Facebook, YouTube are all banned. This is why I love this story so much. This captures the US-China relationship across so many different dimensions. It exposes China's complete lack of reciprocity. It exposes the West's inability to deal with it. And I think also explains why there's always going to be this tension between these two countries. We play by very different rules. If she decides that, let's say, the US version of TikTok coming into China is banned, guess what? It's banned. If someone tries to do that stateside, what happens? It takes ages. Okay. And ages.
Yes, and on one hand, you might say that's a feature, not a bug of democracy. On the other hand, that really raises a question of how you counter a nation that does play by very different rules with a very different set of business goals as they operate in this country. And frankly, when you start talking about TikTok, I think that our minds might have gone to some of the same places in terms of what does this say about our country and young people who, as the former President Trump say, are going to go crazy if they have their TikTok taken away from them. I think that's a little bit of an exaggeration. I think that our young people probably are more resilient than that. I would hope so. But I do think the fact, and you pointed to this too, that the Pew Research Center poll said that about 43% of TikTok users say they regularly get their news there, twice the rate from 3 years ago, and about 1 in 3 of all adults younger than 30.
Well, we've seen a lot of these individuals at the behest of TikTok actually call the representative and say, please don't vote for this. We want to make sure we can keep TikTok. Jonathan, you brought up a point about the fact that it's taken so long. Almost to the day a year ago, I wrote about what CFIUS told TikTok, which was sell or prepare for a ban. That was 1 year ago that my reporting came out. This has taken years to develop, and it kind of went silent for a while. And behind closed doors, you've seen lawmakers continue, especially some of these China hawks, continue to want to get this legislation through. And it took TikTok by surprise how quickly this is about to hit the House floor.
More coverage of this story throughout this morning. Equity futures right now on the S&P 500. Just to get your day started this Wednesday morning, totally unchanged on the S&P. The euro going absolutely nowhere. And at the bond market, the tiniest bit of price action. We're up a single basis point on a 10-year, just about to 416. Coming up this hour, Katie Kaminsky of Alpha Simplex as the equity rally shrugs off another hot CPI print. Kim Wallace of 22V Research with the House set to vote on a bill that could force the sale of TikTok. And David Rosenberg of Rosenberg Research on the state of the economy with the Fed decision just 1 week away. We begin with our top story. The S&P 500 shrugging off another hot CPI print, setting yet another all-time high. Katie Kaminsky of Alpha Simplex is long equities and short fixed income as she says Fed cuts look further away. The key risk for Katie? Sticky inflation, a Fed that does not renounce rate cuts and unwinding momentum with crowded positioning in some key names. Katie joins us now for more. Morning, Katie.
Good morning.
Great to have you with us in New York. Let's start with yesterday. How did you explain yesterday? What was that?
It was wild. I mean, to be honest with you, we have continued to see equity markets continue moving upwards. If you look at momentum signals and momentum positioning, it is at levels that you saw in the tech bubble, which to me is a little frightening. So valuations are high, and the evidence is we're not going to have cuts soon. So it seems like the equity market doesn't care.
Well, part of the reason why, and we heard this yesterday, is because the Fed says that they want to cut, even if there isn't the justification to cut. How much is that underpinning the momentum trade that keeps on keeping on?
Well, that's exactly why I said it's a concern that they're not going to renounce cuts. Because if inflation does come in higher, what does that mean to cut rates when you have inflation? Let's say it went to 4%. That doesn't make any sense to me, in the sense that if you have higher inflation, that's just going to push prices higher, and you're not going to have any restrictive policy to contain that inflation, and it's going to be even harder to stop that type of increase in prices.
So what about the market dynamic makes you think that bonds are waking up to that, or will wake up to that, and stocks will not?
So you've seen that in the price action. Shorter term bonds have actually started going up in yield a little bit more. So the 2-year and the 2-year German bonds has been some of the bigger trends that we've been following on the short side. So it seems like the short end of the curve is starting to wake up a little bit to this. But what's always been very interesting to me this year is there's been a big disconnect in terms of the equity move and how fixed income has been reacting to recent moves, thinking about cuts. And so equity just keeps soaring higher. So I guess they're not, it's not concerned yet. That's why I pointed out the crowding potential and the idea that you have a lot of increases in certain names. So people are starting to get a little nervous about that concentration.
So Katie, how are you positioning for that? If you're worried about that disconnect between stocks and bonds, what are you doing?
Well, you're seeing very different asset class returns, and I want to point out as well that you're still seeing positive correlation between stocks and bonds and higher bond volatility. To us as quants, what that means is that inflation is still driving prices, and what's going on is really inflation-like moves. You're not seeing that classic risk-off relationship between stocks and bonds, thus you're seeing very disparate positions, and you're trading on a higher for longer at the same time as you're saying things look great in the equity market.
Can we throw in the commodity market as well? Just looking at the screen, think about where we've been over the last few months. Gold's up, crude is sideways, iron ore has plunged. So that's inflation, stickiness, and deflation all rolled into one. What signal can you take away from the commodity market?
I love that. The thing that we have seen that has been interesting is the disinflation in the agricultural market. That has been very consistent. What makes me nervous is that's the one thing people have been focused on. And if you see that start to turn, and we start to see goods prices and commodity prices start to turn more on the upswing, then that inflation narrative starts to get a little bit more room to run. But I do agree oil has been tricky. It's very range bound. And of course, some of the commodities like cocoa have been an outsider, which has been up 20-something% in the month of February.
You mentioned cocoa in your note. Does it really matter, these cocoa prices?
It does from a multi-asset trading perspective, in the sense that you have an asset. We initially were kind of shocked because it's Valentine's Day in February. We said, it turns out it was actually much more of a supply chain story. But cocoa matters because it's one of those. It's 27% means that there's going to be push-on effects through the supply chain for an asset like that. But there's a huge dispersion. If you look at corn is way down and cocoa is way up. So it kind of goes to John's point, is you get to pick the narrative you like based on the asset class that you choose. So if it's cocoa, things are going up. If it's corn, things are going down. If it's oil, we don't know yet.
That's what I wanted to ask you about. What's your prospect for oil? Is this solely a China story, or do you see potential risks developing in the Middle East?
So there's been continued volatility in oil prices based on the narrative in geopolitical issues in the Middle East. They haven't had a huge impact on prices yet, but there continue to be starts and stops where you see prices get a little bit of momentum based on news. But in general, they haven't broken out based on political news. And this is quite common in that that's one factor that impacts prices, but it hasn't been sustained so far.
Taking a step back, there's a thesis that seems to be sort of underpinning some of the rally that we're seeing in equities, which is even if bond yields go up, it won't really matter. Because what you're seeing right now is strength in the economy, and the maybe a little bit of warmth in the inflation reads really stems from that growth, which is positive for stocks. At which point are yields problematic for stocks that have seemed immune to higher rates so far?
So I like this point, Lisa, because a lot of people don't want to say this, but because it doesn't sound fun, but it seems like higher yields is less restrictive than people would have thought. Obviously, everyone wants lower yields because it is tougher on middle class and it's tougher on people trying to finance and deal with sort of other issues in terms of business practice. But at the same time, it doesn't seem to be that out of the normal for longer term yields. And for a short period of time, it looks like the equity market is still producing growth. earnings, and we're navigating these higher rates despite the fact that we don't like them.
So, Katie, you staying short in the bond market?
Yes, we're still seeing short signals in the bond market. They are not as strong as they were before, but it has been interesting that we did capitulate and see long signals in January, but that quickly turned around. I'm not seeing a large view on a short, but I do think that there's room to move if we see inflation numbers come up, PCE, and also PPI and retail sales this week.
We've been whipsawed a few times in this bond market, that's for sure. Katie, it's good to see you. Here in New York, Katie Kaminsky there of Alpha Simplex. Your 2-year this morning, higher by 2 basis points, 460. On a 10-year, up by a single basis point to about 416. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. Former President Donald Trump secured the Republican presidential nomination with primary victories in Georgia, Mississippi, and Washington. A rematch between Trump and President Biden is now set for November. Trump refrained from his usual post-primary victory party and instead posted a video statement on social media saying, quote, "We're not going to take time to celebrate. We'll celebrate in 8 months when the election is over." Citadel founder Ken Griffin says the Fed should move slowly in lowering rates so they don't have to reverse course later. Speaking at the Futures Industry Association conference, Griffin said, quote, "Pausing and then changing direction back toward higher rates quickly would be the most devastating course of action to pursue." He thinks the Fed will be slower than people are expecting for that very reason. The Fed's next policy decision is due next Wednesday. Boeing's crisis is growing wider. United Airlines telling the plane maker to stop building its new 737 MAX 10 jets. United confirming it's in talks to substitute planes from rival Airbus. Some of the biggest carriers gathered at a conference Tuesday and discussed similar issues stemming from Boeing's quality concerns. Boeing's stock is down over 29% so far this year. That's your Bloomberg Brief. John?
Yahara, thank you. Elaine Becker coming up a little bit later. One question, Bramo. How much higher are fares going this summer off the back of this?
100%. You talk about all the capacity concerns, talk about inflation, let's talk about getting to, I don't know, Colorado.
Yeah, that story coming up a little bit later this morning. Why Colorado?
Well,
skiing.
Yeah,
all right.
You know why.
Up next, the House voting on a TikTok ban.
We want to make it something that is not a fearful social media platform, but one that is very positive. And in order to do that, we have to see the divesting of it from the Chinese government.
That conversation coming up next, live from New York City this morning. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
really quiet price action to kick off Wednesday morning. Good morning to you. Going nowhere on the S&P, going nowhere in the FX market. The euro 109.29. And in the bond market, just about going somewhere. Yields are higher by a single basis point, 4.16. Under surveillance this morning, the House voting on a TikTok ban.
What we continue to hear are the threats being posed to Americans by the Chinese Communist Party through, in this case, companies, in this case more specifically TikTok.
We want TikTok to exist. We're not there to ban it. I've said we want to make it tic-tac-toe. We want to make it something that is not a fearful social media platform, but one that is very positive. And in order to do that, we have to see the divesting of it from the Chinese government.
It's the latest this morning. The House set to vote today on a bill that would force TikTok's China-based parent company ByteDance to sell the app or face a ban in the US. The bill needs a 2/3 majority to pass before heading to the Senate. Kim Wallace of 22V Research writing this. It is very likely that the bills will become law this month or next. We anticipate strong support in the Senate, with at least 60 senators likely to back the legislation as passed, easing action in that chamber to send President Biden a bill, which he has promised to sign. Kim Wallace joins us now for more. Kim, I want to start with the former president. The former president has form. He's blown up agreements on Capitol Hill before. Why is he struggling to blow up this one?
I think for one reason, bipartisanship has been the key to China-U.S. relations for 5 or 6 years now. And as part of that, the national security concern of the TikTok application and what it means for surveillance back into China is a concern of 3 or 4 years now. The administration, as you all have noted, has worked with the Hill on legislation telling Congress that it needed broader authority. This is that broader authority.
Well, China has already mentioned what they plan on doing. Basically, they say that it's inevitably going to come and bite the U.S. itself. So basically, China's pointing to a potential tit for tat. Do you expect that? Do you expect China to do something in retaliation?
Anne-Marie, the question is what they can do and what they will do. As the U.S. and China work through a transition in their relationship, the administration calls it competition. It's competition across the front on many different platforms every day. And so as you saw coming out of the very quote-unquote successful APEC meeting, when the U.S. and China reignited discussions on all levels, there's still every day a sharp competition between the U.S. and China, not just on worldview, not just on national security imperatives, but also how governments treat people. This is not going to change. We are in a transition going from the happy days of WTO ascension for China to a much more realistic relationship.
We hear from a lot of senators who are now wavering a little bit. I think of Senator Tom Tillis, who yesterday is talking about concerns and about what this could mean, the unintended consequences. This was an individual that last year told Congress they should be leading by example and ditching TikTok on their phones. Who in the Senate do you think is not going to back this? Because you say it's going to get 60 of them.
The people who won't back it probably fall into 2 buckets. One, people who are persuaded by the argument that you shouldn't identify individual companies and freeze them out of markets. And then the second group will be those who are looking toward the election and don't want to do anything that might be perceived as a victory for President Biden.
Let's talk about the tic-tac-toe we were just hearing about and how they want this to exist just in a different format. How could TikTok sell this to any U.S. company with this administration that essentially doesn't like tie-ups of large companies or even medium-sized companies and has really stepped in to intervene at almost every single proposed deal?
Lisa, I think that's the core of why this question has lingered from a policy standpoint for 3 or 4 years. The administration is certain about the national security risk that the TikTok application poses broadly across the U.S. At the same time, they're concerned about precedent. They're concerned about unintended consequences. And as I said before, they're very much concerned that maybe they don't have full legal authority to do what the interagency task force that spoke through the Committee on Foreign Investment in the U.S. last year would want to do. They're looking for a partner. This is typical of Joe Biden. He is a man of the Senate. He has ideas, but he wants to have partners in the legislature.
So even if this does get passed, are you saying, Kim, essentially nothing will actually happen for a very long time?
It's hard to know. Remember, at the end of the Trump administration, Oracle was brought in by the DOJ and a deal was struck that they would be sort of a constant backdoor to traffic over TikTok, and they could monitor without the company knowing. You come fast forward to the legislation doesn't require ByteDance to divest. It just says that the application cannot be operated in the U.S. if it comes from 4 countries, China, Russia, Iran, and North Korea. TikTok obviously is associated strongly with China.
Kim, we got confirmation last night of Biden-Trump Volume 2. A lot of people in this country didn't want to see it. That's what we've got. With regards to this TikTok story, I think we've got a decent idea, as you've been explaining, as to how the current president is going to govern if he gets a second term. Do you have a decent idea of how the former president will govern, given how this story has played out?
John, it's a great question, and I think TikTok is a wonderful example. President Trump is known to be former President Trump is known to be very transactional, and it is the fact that some of his friends have positions in TikTok that has caused him to waver. This is not new. We saw this in his second year with ZTE and Huawei. His administration was set to basically put ZTE out of business, at least in the U.S., and he heard from friends who had positions in the company. It's 2 very stark different views of how to govern. And as much as people say, including me, Americans do not want this rematch, it provides Americans who are strongly divided a very stark choice in governance.
We potentially are going to see this bill. I just want to come back to it passed in the House today. You mentioned how this would be a win for Biden. But my question is, 8 months before the election, this has issues for both Republicans and Democrats. Why are they doing it now, Kim?
Anne-Marie, first, I did not mean to imply, and I think I heard myself say it's a win for Biden. I don't know that either party plays this issue very well. It's like immigration and others. I'm not sure it's a clear win for anyone. But the administration has been, for the last 3 years, very intent on the national security risk. To that extent, it might be perceived as a win. Outside of that, politically, I don't know how this plays. I don't think anyone does.
Hey, Kim, great to get your thoughts. Appreciate your time this morning, sir. Kim Wallace there of 22V Research on this bill going through the House a little bit later on this morning. 10 a.m. Eastern time, is that right?
Well, that's when the House will be coming back in. Let's see. Sometimes these things tend to take a little bit more time.
Just on this story, the former president clearly doesn't want this bill to go through. He's come out pretty clearly against Meta. Does that set us up for some kind of pursuit of Meta in the years to come if he gets back in the White House?
Well, remember the FTC already has an ongoing issue with Meta in terms of thinking they're a monopoly, especially in the fact that they bought up Instagram and WhatsApp. That happened at the final weeks of the Trump administration. And then FTC Chair now Lina Khan is dealing with it. And it's still ongoing. But I think whether or not it's a Biden or Trump White House, these antitrust issues are not going away.
The issue is we keep flirting with this question of what are social media pro platforms doing to children and their minds and their education. And I will just say, as a mother of children, it's an ongoing concern. And I think that there are some conflicting messages from the types of policies that are driven from concern but lack of evidence.
Yeah, if you have a child that is interested in communism and wants to be a communist, I think maybe look away from TikTok and look towards who's teaching them. Because if they're not being taught about the pitfalls of that, then that's a problem with the education system, not the platforms.
There's a lot of questions.
That's a lot to unpack there, sure.
Do they understand the propaganda they're being fed?
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
From the UK, and I'm the inventor of the Gel Razor. And today I'm looking for an angel investor to fund my project, the Gel Razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did that all in one. The idea is you pressurize the handle. The gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September with copyright protection. I have a logo for the Gel Razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
I wonder if that sort of evolves in a favorable manner for the Federal Reserve.
A lot of people looking to certain components that did see a little disinflation that will make it easier. That said, what inflation data dependent Federal Reserve can look at this and feel confident that they're on their path down to 2%? I am struggling with that. The market seems to think it's less of a struggle.
You're not alone. We'll catch up with Rosenberg about this in just a moment. Let's finish on foreign exchange. The euro at about 109, 109.30. Heard from a central bank governor a little bit earlier this morning, one from France, another one from Austria. Both of them really just leaning into June. June seems to be the month for the ECB for liftoff.
Yeah, you're talking about Villeroy. Francois Villeroy.
Your buddy in France,
yes, exactly. I mean, honestly, he's talking about pushing it back to June. The market doesn't believe him. So, you know, the rhetoric at this point isn't matching with some of the actual data points. And in Europe, they actually have a reason. You're not actually concerned about an overheating economy. In the U.S., it's a little bit different. So at this point, how much is job owning going to work?
True. Let's finish on foreign exchange and dollar yen specifically. 147.95. That currency pair just firmer by 0.2%. A slightly weaker Japanese yen off the back of this story this morning. Under surveillance, our top story, the BOJ monitoring wage hikes as automakers boost pay and meet union demands. Toyota will raise salary and bonuses for a 4th straight year. The auto giant joins Honda, Mazda and Nissan, who have all agreed to raise pay during annual spring wage negotiations. Governor Ueda saying this year's wage talks are an important item to watch heading into next week's decision. This is a big one. I think we're something like 5 to 6% with the wage hikes at the other manufacturers. We didn't actually get a number from Toyota this morning, but this is the direction of travel in Japan.
And the reason why you think that Friday is the most important day of the week, right? You think that that's going to be the data point when they get you some sort of
big union.
Deal?
We find out what that wage hike is like.
Jonathan Farrow, avid follower of Japanese unions. So there was this one union that represents about 60 different groups that did secure this 5.3% price increase overnight. So people looking into this as a signal, given the fact that that's the fastest wage growth that we've seen going back decades. Again, it's just a matter of when and how they message it. So at this point, the tea leaves, I don't know. Do people kind of move on and just say, okay, it's going to happen?
I think messaging matters. Dario Perkins over in London put this beautifully this morning out on Twitter, X. He said this, 5% wage growth in Japan, virtuous wage price cycle. 5% wage growth in the Eurozone, which we spent a decade battling the risk of Japanization, dangerous wage price spiral. Isn't it different? In Europe, it's a dangerous wage price spiral, and in Japan, it's a virtuous wage price cycle. It's a very, very different way of looking at the same thing.
Two things. Is the Japanese economy structurally different than Europe and the U.S., and Europe in particular? Some people might argue no. And if that's the case, is it wrong to fight inflation? It gets to the question of whether central bankers think it might be good to run the economies a little bit hotter to avoid the Japanese-like spiral, which brings in a whole other ball of worms, which may be why the Fed is excited to cut maybe beyond what people would expect.
Friday, big day, wage negotiations, big union in Japan. It's going to shake up dollar yen. We'll look out for that. I want to turn to this story. Donald Trump and President Biden securing enough delegates to clinch nominations in their respective parties. Voters in Georgia, Mississippi, Washington helping to finalize a rematch of the 2020 election. Trump continuing to take further control of the GOP, firing more than 60 staffers in the RNC as it shares closer ties with the campaign. Yesterday, President Biden was meeting with leaders of the Teamsters Union in a bid to help secure an endorsement. A worry that maybe they're looking in Trump's direction.
Well, yeah, because when you look at the polling of individuals at the rank and file, less so the leadership of unions, you have seen Trump actually gain some of the momentum with those individuals. That's why Biden, not just because he wants to be the most pro-labor union president in history, he also wants their endorsement. This story is a little bit of a shrug. It's the rematch we all knew was coming. It's the rematch no one wants, but it's going to cost a fortune because it means the general election is so much longer. And these individuals have to be in the public eye longer. They have to campaign longer. This is going to be expensive, and it's going to be difficult more so for the Trump campaign than the Biden campaign because Trump is paying his legal fees with some of these campaign donations.
It begs the question, and I thought we'd hear more about this overnight. Running mate, when do we find out?
Not sure yet. I mean, there's a few people that are, on the short list. Elise Stefanik comes to mind. Katie Britt comes to mind. Maybe that audition tape. Not sure how well that went down with some members, not just the electorate, but even the Republican Party.
Kristi Noem.
J.D. Vance, Kristi Noem, Vivek Ramaswamy. Trump loves to also play kingmaker. And I think for a little bit, he loves this idea, this aura around it. He has a number of surrogates going out on the news for him, so maybe he'll just wait to decide on the VP.
Slightly random, but I want to squeeze this in. Kristi Noem, did you see the governor on Twitter yesterday promoting a dentist in Texas? It's the weirdest video. You want to go and have a look at it? Go and have a look at it. It made no sense at all. What was that about? Any idea at all?
Not sure.
Dental surgery in Texas. It was really, really bizarre. I thought she'd been hacked. I thought she'd been hacked when I saw that.
Well, there's sort of these small stories. How do you relate to the people? Maybe that's one way.
Oh, that's one way.
Yeah.
I guess
why
maybe.
in Texas, though? It would make more sense.
That's why none of it made sense at all. Let's finish on this story. United Airlines telling Boeing to stop building 737 MAX 10 jets as it switches to a rival Airbus model. The warning coming as a path to certification for the MAX 10 becomes uncertain. United CEO Scott Kirby making the comments at a JP Morgan investor conference. Deliveries for Boeing 737 jets has slowed to 17 from 25 month over month. Southwest also warning its schedules would be cut and hiring plans would be frozen due to Boeing's weaker output. Helene Becker of TD Cowen joins us around the table. Helene, we've been looking forward to this because I only have one question, and then everyone's got tons more than me. How much are fares going to go up this summer because of this?
Yeah, they're heading up, and we're thinking sort of mid-single digits, and then maybe a little bit more in markets that people want to go to. Europe comes to mind. Asia is growing this summer. Domestic U.S., a lot of capacity has come out of the U.S. market, so we're definitely seeing fares going up.
So the logical question is, how much is this truly because of Boeing issues, and how much is this just because they want bigger margins?
Yeah, I think it's a combination of both. I think there are a lot of things that are playing on the industry that are causing airfares to go up. And first of all, you've had huge labor wage increases across the board. Flight attendants are negotiating now, and they're just past peak, so they may not get the sizable increases pilots got last year, but they're still going to get big increases. So that's one thing to think about. And then you have infrastructure issues. The FAA has asked the four big airlines serving the New York market to cut capacity by 10%. They did that last year, and they asked that it continue at that level through October of this year. So for 18 months, you're seeing growth in this market, but you don't have capacity to fill the seats. And then if you look at what the airlines have been doing, they upgauging more seats per departure and fewer departures per day, which is something we've been talking about since before the pandemic. Because the delivery delays, you still have relatively small aircraft. So you have capacity down, say 5 or 7% from where it was, but you have demand up 10% from where it was, 6 to 10%, depending on day of week and month of year. And so fares have no choice but to go up.
I find the story fascinating from a personal perspective because I like to travel, but also from an economic perspective because a lot of people have been pointing to the fact that spending has been so resilient in the airplane sector, that you have seen just so many people continuing to travel, even as this narrative of some sort of crimped budgets and savings running out has played out. What do you make of this? That basically, is this a priority area or is this a sign of a consumer that just has plenty of money to spend?
Yeah, that's a really great question because I thought last year as we had inflation, higher food costs, higher fuel costs, most people drive to work, so more money for gasoline, all of the things that you guys have been talking about this morning with respect to inflation and higher interest rates, student loan payments, blah, blah, blah. I really thought we'd see demand come down, and it hasn't. To your point, it's been very strong. And what I think there are two things playing on that. One is I think people are just tired of being cooped up for so long, and they're just hitting bucket list trips. And and they're afraid potentially that they're going to have to go back to work 5 days a week instead of 4. And so I think that's one thing that's weighing heavily. And I think the other thing that's weighing on consumers is the idea that the world is changing and the places they want to go may not be available for them to go to in the future. So think about pre-pandemic, things like where were bachelor and bachelorette parties taking place, right? We saw a lot of them in Nashville, Asheville, Miami, but then they shifted to Montreal and Iceland and Cartagena and in Colombia, and then they shifted to Europe. I mean, really crazy places, but not all those places may be available as we think about the future of travel. So I think people are just squishing it all in as soon as they can.
I'd love to know who's doing these bachelorette parties. I have not been invited to one of these.
JetBlue to Cartagena, in case anyone's interested.
Is that what you were looking up over there? When you look at raising bag fees, American, Delta, United all just did it as well. Mm-hmm. Wall Street Journal recently wrote about how they're coming after as well your carry-ons. What kind of bag fees are we talking about? And it feels like the airlines are going after anything they could potentially make money off of and on top of the fact that airfares are going up.
Yeah, so this is a dangerous game I think they're playing, right? Bag fees hadn't gone up in, 3 or 5 years, so they went up $5 recently. But a lot of people, you can get away with not paying those bag fees if you have the credit card, if you have status. So what they're really doing is driving loyalty to their programs, and that's easy to do if you live in New York and you're a JetBlue, United, American, or Delta frequent flyer, or Dallas and you're American and Southwest. But when you get to the mid-con, where there are no hubs, then you're really not a frequent flyer. So that's where you either need to have an airline credit card, and most Americans don't. Most Americans have the cash back card and then a gasoline card. Airline credit cards are down the list. So they're the ones that are impacted. But people with status, corporates, they don't pay the increase. So it's the infrequent traveler that kind of gets caught both ways.
Elaine, just a final question for me. Just how American Airlines can capitalize on this moment, and how sensitive that consumers might be to the manufacturer of the plane they're flying on. Is that even a thing yet? Are you seeing that? Consumers sitting there and saying, I don't want to fly with United. They buy lots of Boeing. I want to go with American Airlines instead. Is that a thing?
You know, it should be, but it's not. I think people really don't look at the aircraft they're flying on until maybe they're flying on the plane. And then they see, oh, I'm on an A319, or this is the smallest plane I've ever been on. It turns out to be a regional jet, or, you know, whatever. But I don't really think they focus on the aircraft type as much as the schedule. First and foremost, am I loyal to this airline? Do I have the airline credit card? Am I getting double, triple, whatever points? And then the second big thing, what's the schedule? When am I going to get there? How reliable is the airline? You know, I think that's a big issue for people. If you plan your trip around, you know, your baby's nap time or something, or, you know, business meetings or whatever, you really don't want a 2 or 5 hour delay, because it kind of screws up all your plans.
True, before you go, top pick right now. What is it? What'd you like?
Yeah, so we really like Delta, United, and Copa. Those are our top 3 choices, with Delta our best idea for 2024.
Cool. Elaine, good to see you.
Thanks.
Enjoyed it. Thank you. Elaine Becker there of TD Cowen. I don't think consumers do that either. I think this is what Michael O'Leary of Ryanair believes too, which is why he's still looking at Boeing.
I'm so concerned. Price lower. Poof.
Right, there you go.
I mean, that's basically it.
And status. I took a pit stop in London for points while Jonathan flew direct, and he couldn't believe I did it.
Isn't that what you're meant to do? Just fly. Why wouldn't you just fly direct?
Yeah, well, I mean,
I was trying to save the planet, and AMH just cared about points, which is just a terrible thing.
I don't even travel because I'm trying to save
Exactly.
the planet.
You should walk. Let's get you an update on stories elsewhere this morning. You really should stop doing that. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Fires erupting at a major oil refinery in Russia after a drone strike from Ukrainian forces. The facility is about 120 miles southeast of Moscow and serves as a key supplier of fuel for the eastern part of the country. The strike marks the second instance just this week of Ukrainian drones damaging Russian oil facilities. President Vladimir Putin saying the attacks aim to interfere with Russia's presidential election happening this week. A warning from the president of Poland. In an interview on Bloomberg's Balance of Power, President Andrzej Duda said Vladimir Putin would attack other states if Russia wins its war in Ukraine. His warning comes at a critical moment in Ukraine's war with Russia, as allies are scrambling to provide more military assistance to Kyiv. Questions about President Biden's mental fitness took center stage with special counsel Robert Hur on Capitol Hill. He's the prosecutor who declined to charge the president over his handling of classified documents in a report that described him as a well-meaning elderly man with a poor memory. Hur defended his decision, saying, "I understood that my explanation about this case had to include rigorous, detailed, and thorough analysis. I cannot simply announce that I recommended no criminal charges and leave it at that. I needed to explain why." And that's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, hot inflation, leaving some investors split.
Yes, inflation's going to come down slowly. And I think that's fast, you know, I think that will be fast enough for the Fed to start cutting in June.
They're telling you we want to cut rates. The problem is the data is not letting them.
That was a fantastic conversation yesterday. More on that in just a moment. Live from New York City, this is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges. Britain's next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Equity futures on the S&P 500 just about positive by 0.06% after closing at all-time highs in yesterday's session. Yields a little bit higher by almost a single basis point on a 10-year, 415.86. Under surveillance this morning, hot inflation leaving some investors split.
What I think is going to happen over the course of this year is, yes, inflation is going to come down slowly. And I think that's fast, I think that will be fast enough for the Fed to start cutting in June.
They're telling you we want to cut rates. The problem is the data is not letting them. And this has been the driving force behind our call all year, that they probably weren't going to be given the opportunity in 2024 because the economy is not going to give them the opportunity.
Here's the latest this morning. Hotter than expected CPI, reinforcing the Fed's cautious approach with 1 week remaining until the next Fed decision. Plus, more data on deck with retail sales and PPI due tomorrow. David Rosenberg, president of Rosenberg Research, writing, quote, "There is nothing in the CPI report to get the Fed in a position to be cutting rates anytime soon." I'm pleased to say that David joins us now for more. David, great to catch up with you, sir. It's been too long. I just think you're perfectly positioned to run through this for us in detail. The pieces of this that will spill over to PCE, the bits that matter to the Fed, and ultimately the parts that won't.
Right. Well, look, I think that the bottom line is that the Fed does not target the CPI or the core CPI. It targets the PC deflator and the core PC deflator. And I think that one of the, more welcoming elements in yesterday's CPI data was the fact that medical care, goods and services were flat as a pancake. And that features much larger in the PC deflator. And I wouldn't be surprised when you reweight the components of the CPI to the PC deflator that the core ends up coming in closer to 0.3 or 0.2 than the 0.4 we saw in the core CPI. So my view was that yesterday's consumer price report is going to be a distant memory within the next 3 to 4 weeks. So I'm not as fussed about it as a lot of the other commentators you had on your show.
It seems like, David, that the markets agree with you. Are the markets responding appropriately to a report that you think is maybe a bit misleading?
Well, look, the stock market is really operating on a set of momentum and technical factors and not really, I don't think, paying attention much to what's happening in the economy. I mean, you have a stock market up 30% in the past year, thereabouts, and earnings are up 4%. So it's really been a multiple-driven market. The bond market sold off moderately, as you would have expected, on a higher than expected, especially core CPI print. But in the overall scheme of things, I mean, you have people on your show saying that, inflation is taking its time coming down. And inflation usually does that. It's like a race between watching grass grow and paint dry. It's not, inflation isn't Bitcoin or the CRB index or NVIDIA stock. It usually is glacial. But the bigger picture is this, when we strip out the shelter components of the CPI, which we all know are flawed in their treatment and they're lagged, headline inflation ex shelter is running at 1.8% year over year. It's already below target. This time last year, it was running at 5%. So I would just suggest let's move away from focusing exclusively on the monthly wiggles on the data and look at the bigger picture, because the broader trends in inflation and core are moving down, and I think moving down in a rather impressive fashion, notwithstanding yesterday's data point.
I guess what strikes me, David, is it seems like the balance of risks is perhaps a little bit more skewed to higher inflation after this report, especially because it doesn't seem like rates where they are now are particularly restrictive when it comes to capital markets and when it comes to risk asset valuations. So why should the Fed go ahead with cutting rates at a time where it doesn't seem like their higher rates are really affecting the economy or markets? And it seems like there still are questions around inflation.
Well, there's no doubt that financial conditions have eased rather dramatically in the course of the past few months. But I don't think that's why the economy did as well as it did last year and into the fourth quarter. It was really a lot of fiscal juice. It wasn't really about financial conditions. You got a rapid decline in the equity cost of capital. High yield spreads are super tight, but where's the CapEx boom coming out of that? We're not really seeing it. Last year's story, 2/3 of the growth in the economy last year came from the direct and indirect impact of fiscal stimulus, which frankly I wasn't expecting. I don't know if you were expecting it. I wasn't expecting that the deficit was going to expand 25% last year in the context of a sub 4% unemployment rate. That's never happened before.
So true.
So a lot of the growth was really fiscal. Financial conditions have eased, but I'm not really seeing any dramatic impulse on economic activity from the easing in financial conditions. And the one thing I'm going to point out is, the Fed is telling us increasingly that it is, shifting its focus from the month-to-month gyrations in the data, of course, that grab the headlines until the next month's data come out, and they're focused on what business contacts are telling them. And quite frankly, when you look at the swath of comments coming out of the Beige Book, the latest Beige Book out of the Fed, what did it say? It said that businesses found it harder to pass through higher costs to their consumers, who became increasingly sensitive to price changes. So that's what's happening in the real world. And in the CPI world, we have over 40% of the items in that index are imputed guesswork by BLS statisticians as it pertains to services. So when you look at the real world, what did the Walmart CFO tell us a couple of weeks ago about pricing trends at Walmart, the world's largest retailer, is that their pricing momentum is actually dissipating. So I'm not getting too fussed by one monthly CPI number, that's for sure.
David, I've got about 45 seconds left with you. I wanted to squeeze this in. There's a phrase I see a lot from research at the moment, and it's not 1999. And I just wonder, from your perspective, what is the value of benchmarking to such an extreme time in the equity market? Is there any value in that at all?
No, I don't think that it's useful to compare it to today's world to any other world any more than in 07, people comparing it to previous cycles. Every cycle has its unique characteristics. Every cycle has its similar patterns. No, I'm not saying this is like 1999 or the dot-com bubble, because most of those companies didn't have a business model and didn't have earnings. However, we do have a situation where the forward multiple now in the S&P is 21. And it is in the top 10%, the top decile of valuations in history. So it doesn't detract. People like to say it's not 1999. Well, go knock yourself out on that comparison. But whether you're taking a look at corporate credit, you're taking a look at the equity market, it's a nosebleed territory in terms of valuations. And so that's where I come out of it, that it's still a very expensive set of circumstances in across most asset classes.
David, we're going to continue this conversation.
It's not as dire as it was in '99, but it's
another
still a
time.
strain.
David Rosenberg of Rosenberg Research. David, appreciate it. It's live from New York, the second hour of Surveillance. Up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Stocks still represent the best place, particularly U.S. stocks, if you want to compound your wealth.
This is still a year for us in terms of U.S. exceptionalism. It's hard to get too spooked by stocks when earnings have been as strong as they have.
If you keep printing 150 or 200K jobs in the U.S., it's really hard to not like owning equities in that environment.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stage ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
On the Fed's next goal, and Woody Caesar of credit sites calling for the yield curve to disinvert by year end. We begin with our top story. Stocks shrugging off a hotter than expected CPI print to post the biggest day of gains in almost 3 weeks. Catherine Keating of BNY Mellon Wealth Management telling investors to stay in equity markets and calling bonds a, quote, once in a decade opportunity, saying while cash was the move 2 years ago, now is the time to move into bonds. Catherine, I'm pleased to say, joined us now for more. Catherine, great to see you.
Great to see you. Thank you.
You've got one of my favorite quotes, and whenever I hear this, I always read it twice. Missing just the best 20 days in the equity market over the past 30 years cuts returns in half. Missing the 40 best days results in negative returns. That always shocks me whenever I read it, whenever I hear it. Is half of your job therapy to keep people in the equity market?
I don't think it's therapy, but I think it's reminding them that the biggest advantage that an investor has is time. Time in the market is much more important than timing the market, because over time, markets go up. So staying in the market, being invested, that doesn't mean being static. That doesn't mean you don't make judgments about which asset classes you think are stronger. But being in the market is the most important advantage that an investor has.
That might be true broadly in the United States, but lost decades are not unusual. We've seen them in Japan. More recently, we just recaptured an all-time high. It took since 1989 to get back there. So what makes the United States and the US capital markets somewhat unique in that regard?
So we're a large and highly liquid market, obviously, but if I step back and think about the U.S. market today and where we are, number one, we have a very good ecosystem to invest in. We have a growing U.S. economy, 2% or so this year. Number two, large companies in this country in particular are relatively insulated right now from higher interest rates. And why is that? Because when rates dived in 2020 and 2021, they took advantage of that. And they refinanced debt and they extended maturities. And so right now, large companies in this country are actually relatively well insulated from higher rates. That will change as years goes on, and it will definitely change by the time you get to 2030. But for right now, companies are doing well. Earnings are positive. We're out of the earnings recession of last year. Fundamentals are good. And so we think that it's a good place to be.
You know, I was really excited to speak with you about the psyche of the retail investor this morning, given the fact that you're seeing all-time highs and how that feeds into their willingness to spend. I know that you work with them on both sides of this. Do a lot of people directly increase their spending when they see bigger gains from their investments?
Yeah, so the answer is that depends. If we step back and we think about the consumer, which is 2/3 of the economy, and the individual investor, which is 2/3 of investment assets, that individual is actually in pretty strong shape right now. Just as large companies took advantage of low interest rates and are relatively insulated from the higher rates we have right now, so are individuals. What did people do when mortgage rates went down dramatically in 2020 and 2021? They refinanced. They locked in lower rates. And of course, mortgages are the largest category of consumer debt. At the same time, consumers and individual investors have been very responsible in how they're handling their balance sheets. You know, debt service is less than 10% of disposable income, very strong for the consumer.
I guess that what I'm trying to get at here is when we're looking at CPI yesterday and trying to understand the resilience of the consumer, I wonder how much of a role markets are playing. That essentially there's been an easing in financial conditions and people are earning pretty hefty returns on their stock and bond investments so far this year, last year, et cetera. How much does that bolster their ability and willingness to spend, keeping this sort of cycle going?
Well, this is a very good question, and you're absolutely right. There is a very important wealth effect that impacts the individual investor and the consumer. And if you think about consumer wealth broadly, it's up 30% since before the COVID crisis. Why is that? Prices of homes are up, markets are up, and so you see a consumer wealth number of $150 trillion, up $30 trillion just over the last 4 years. So the wealth effect is very profound. You're absolutely right.
How reluctant are clients, investors, to get back into bonds? This is a big push of yours. How reluctant are they?
So there's no question about the fact that the last 2 years you were better off in cash, right? The Federal Reserve has anchored these rates at 5%, better off in cash. The question for every investor is, where will you be better off the next 1, 3, and 5 years? You're always investing for the future, not the past. And we are confident that you will be better off in bonds over the next 1, 3, and 5 years. And the reason for that is that we have a lot of experience, and we know that when you reach peak Fed funds rates, then they do start to go down, and we can debate the path and how quickly, but they do start to go down. And when that happens, bonds appreciate. And you tend to see returns in the bond market that are 2 times and 3 times the returns on cash. So we're highly confident in that. And in particular, we like municipal bonds for 3 reasons, right? Our clients pay taxes, right? They're tax exempt. Number 1. Number 2, the municipal bond market is a very strong active management market, right? There are 500 stocks in the S&P 500. There are 80,000 municipal bond issuers. So there's a lot of opportunity for that. And then number 3 is the point that I just made. If you add duration now, as rates go down, the price goes up.
Catherine Keating is going to be sticking with us to talk about this bond market. If you are interested in where we're trading right now in the bond market, Lisa, the 10-year up about a single basis point, 416, the 2-year 460, just off the highs of where we were a few weeks ago. I think a big question right now would be, have we seen the high for the 2-year yield so far this year?
It's a great question, especially because it's almost sacrilegious to say that the Fed isn't at their peak rate, because they're basically saying that they are. But here's the question, what are we going back to? Is this sort of a natural progression to back to 2% or not? And ultimately, that is the ultimate question that's splitting Wall Street in some of their prognostications about peak rates and where we go from here.
Just on the timing, do you remember post-GFC? Do you remember all those charts that just showed where Wall Street thought rates were going? And it was just sort of like lift off, false dawn, lift off, false dawn. And we always thought rates were going up, and they ultimately never did. Is post-pandemic going to be the inverse of that chart, where it's like cuts, false dawn, where we're just sort of waiting?
If you knew that answer, I'd have to kill you.
I'm interested.
Yeah, but I think it's a great question. And I think ultimately, Everyone disagrees on the answer, depending on who you are, depending on whether you've got a sort of more inflationary regime or whether you've got a disinflationary regime. This is the key question right now, I would say, of 2024.
I feel like you've got something to say about that. Have you got an answer to that? Do you think we could have the inverse of that chart in the years to come? Just false dawn after false dawn, looking for rate cuts that don't come?
Look, the Fed has a dual mandate, right? Full employment, price stability. Full employment, check, right? Unemployment has been below 4% for 2 years, even as it's creeping up. They are highly, highly focused on price stability. So back to the CPI, you know, the long-term trend over the last couple of years is quite clear, over 9% down to 3.2. But the path from 3.2 to 2 really depends on three things: the components of CPI, goods, services, shelter. Goods, we've historically had no inflation in goods in this country. It's a highly competitive market. We're back to almost no inflation now on goods. If you added goods and services together, we'd be at about 2% CPI. So the real issue is shelter, which is the largest component. And when we think about it, you know, you sign a lease for a year. Your mortgages are long-term. So it's really all about the shelter component. And one of the reasons that the market did well yesterday is because they saw that come down a little bit from January. So that's the question about inflation. Shelter, shelter, shelter. And how sticky is it and when does it come down?
You're taking the tiniest bit of comfort from that, relatively speaking. Catherine, you're going to stick with us, I'm pleased to say. Equity futures on the S&P 500, just about positive. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. A warning from the president of Poland. In an interview on Bloomberg's Balance of Power, President Andrzej Duda said Vladimir Putin would attack other states if Russia wins its war in Ukraine. His warning comes at a critical moment in Ukraine's war with Russia, as allies are scrambling to provide more military assistance to Kyiv. Boeing's crisis is growing wider. United Airlines telling the plane maker to stop building its new 737 MAX 10 jets, and United confirming it's in talks to substitute planes from rival Airbus. Some of the biggest carriers gathered at a conference Tuesday and discussed similar issues stemming from Boeing's quality concerns. Boeing's stock is down over 29% so far this year. A setback for a Japanese startup hoping to enter the crowded commercial space race. Space One's first rocket launch exploded in flames just seconds after taking off. The company's CEO says a self-destruct order was sent to the unmanned vessel about 5 seconds after launch, with a panel to investigate what happened. Space One was trying to send a government satellite into space. And that's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, it's Biden-Trump once again.
I extend an open hand, an open invitation, and I ask you to join us on the noble quest of saving our country.
Folks, it's not hyperbole to suggest our freedoms are literally on the ballot this November.
How many months of this have we got? 8?
8.
Something like 8 months, wow. All right, that's next on the program. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup.
This is a three as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Stocks on the S&P 500 closing yesterday at record highs, all-time highs. Coming into today, equity futures adding some weight to that, up by 0.6%, 0.06% higher on the S&P. Yields are up a single basis point, 416.25 on the US 10-year. The euro slightly stronger, 109.35. Under surveillance this morning, it's Biden-Trump once again.
If you're a disillusioned Democrat, of which there are many today, I extend an open hand, an open invitation, and I ask you to join us on the noble quest of saving our country.
When I gave my State of the Union address, I talked about how far we've come since the 2020 election. I also talked about how much is at stake. Folks, it's not hyperbole to suggest our freedoms are literally on the ballot this November.
How much Red Bull gets consumed between now and November? That's what I want to know. Here's the latest. Former President Donald Trump clinching the Republican presidential nomination, crossing the threshold for the number of delegates needed to become the nominee in yesterday's primaries. Trump is now set for a rematch with President Biden in November. Bloomberg's Michael Shepard joins us now for more. Shep, I want to know the running mate. Who's the running mate going to be for the former President Donald Trump, and how long are we going to have to wait?
Jonathan, I think we all want to know who the running mate is going to be, and we've seen a few names kicked around out there. We can be sure that it won't be Nikki Haley at this point, just given the distance between Trump and his former U.S. ambassador to the UN. They had a bitter campaign, but there are a lot of other interesting names out there. If you're Donald Trump, you will want to make every bit of this moment in the search for a running mate, and I would expect him to try to build the momentum and build the suspense and get as many of these prospective contenders down to meet with him, maybe even in public settings at Mar-a-Lago in coming weeks.
Speaking of Ambassador Haley, she got more than 77,000 votes in Georgia yesterday, Shep, and she wasn't even in the race. She's bowed out. She said, I'm not going to run for president anymore. How difficult, given the fact that Trump lost Georgia by under 12,000 votes, how difficult is this going to be for him to make sure he can bring those Haley votes over to try to win back a state like Georgia?
Well, that signals the big challenge that Trump faces and the underlying weakness that Haley was trying to point out during the campaign in a Trump candidacy. What she was arguing before she left the race is that there are a lot of Republican voters who don't want Trump on the ballot. And these were the people who were backing her. And some of them have indicated, even in conversations with me during our trips to Iowa and New Hampshire, that they would rather vote for President Joe Biden if it came down to it than for Donald Trump. Biden himself has made an appeal to those Haley voters. We heard Trump trying to make an appeal to Democrats who are dissatisfied. But likewise, Biden is trying to reach that group of Republicans that has had enough with Trump and would rather see a changing of the guard, had put their bets on and their hopes in Nikki Haley, only to be disappointed.
Speaking of changing of the guard, the Speaker of the House is a Republican. And we've seen almost peak dysfunction, I would say, yesterday with Congressman Ken Buck saying, we already know he's retiring, but he's basically saying, this is so dysfunctional, I'm leaving at the end of next week. How will Republicans do down ballot for the House of Representatives and the Senate in November?
Well, this poses another challenge for the party with Trump at the top of the ticket. You'll remember that during the midterm elections, Trump was widely blamed for contributing to the party's underperformance. Even though he wasn't on the ballot, it was just the fact that so many Trump loyalists were, and they didn't perform nearly as well as he had said they would and as the party had hoped they would. And Ken Buck had notably broken with Trump. He voted to certify the election in defiance of the president's wishes back in early 2021. And he had further disagreements with the former president over the past year and a half. So this signals two things. One, that you're right, that The House is a very dysfunctional place. Ken Buck didn't even give Mike Johnson, the Speaker, a heads up that he was going to make this snap retirement announcement. But it also does signal another thing, that Trump's hold on the party is actually tightening. And that we could see a more Trump faithful candidate emerge to take Ken Buck's place.
Shep, how does that reconcile with what we're about to see on Capitol Hill today regarding TikTok?
Well, it's a great question because, the House, as we know, is about to vote in a couple of hours on a measure that would seek to force the sale of TikTok, force its Chinese owners to sell the app or face a ban if they don't do so within 6 months. Now, this measure has gained steam very, very quickly in the chamber. It surfaced from out of nowhere after months of silence. Just last week, it passed this committee on a 50-0 margin, and we expected to get through the House by the 2/3 majority it would need to pass. Now, where does Trump come in? Earlier this week, he signaled his opposition to the measure, saying that if it passed, it would help Facebook. And his concern is that Facebook would become too powerful, and he would prefer to see TikTok in some sort of a more competitive relationship and really coming up against Facebook. And remember, Facebook banned Trump shortly after the January 6th attack on the Capitol. That is one thing to note. There are also some other misgivings among Republicans, especially the more libertarian ones who would align with Trump anyway. And their concerns are more over free speech.
Shep, we've got to leave it there. It's good to catch up. Looking forward to that vote a little bit later this morning. Michael Shepard there of Bloomberg. I'm reminded of a line that came from Mark Dow maybe 8 years ago around the 2016 election, where he said the biggest challenge for investors was to divorce your politics from your market views. Over the weekend, JP Morgan's David Kelly wrote this in Barron's in an interview. He had this to say: I worry that people worry too much about politics. There are a lot of Republicans who missed out on good stock market returns under Presidents Obama and Biden, and a lot of Democrats who missed out on great stock market returns under Donald Trump. David Kelly in Barron's over the weekend. Read that interview. Catherine Keeling's back with us. Catherine, does that echo how you feel about politics? Do you have to divorce your politics from your market views, and how easy is that to do?
Yeah, to a certain extent you do, because as David said, markets have done well regardless of which party is in control. And when you actually think about it, elections are about policy. Elections are about policy, but you don't know what the policies will be until you know who wins the presidency, the Senate, and the House, and most of the time, that's not a single party. One thing we do know about election years, though, and this is actually a very sort of consistent tactical trend, is that ever since World War II, when the incumbent president is running for re-election, that tends to be a very positive year in the markets. And so if we just step back and think about this year, we have an incumbent president running for re-election. And what do we see? We actually see a lot of positives for the market. The Inflation Reduction Act, the CHIPS Act, that money is coming into the economy right now and being spent. So Congress is talking about a fiscal bill right now. So what you see in every election since World War II where the incumbent is running for president, whether they win or lose, it tends to be a very good year in the equity market. And in fact, it tends to be twice as good as the average year, up about 15%. And, we're sort of on track for that right now.
Does it matter more to you about who would be potentially the next Fed chair?
Oh, the Fed chair is very important to the economy, obviously, right? Controlling interest rates, helping to control inflation and full employment. But so the
Trump
Fed
has
chair
floated
is
some
very
interesting
important.
names in the past. That's why I bring it up.
Yeah, the Fed chair is a very important pillar of the economy, absolutely.
Catherine, we've got to leave it there. It's good to see you.
Good
Catherine
to see
Keeling of BNY Mellon Wealth Management. To Catherine's point, is the president likely to choose a Fed chair that somehow goes against his objectives for the US economy? I think it's highly unlikely. The inflation dynamic, though, is the one to watch.
You've asked this many times, and this is what I keep thinking about. How long does the U.S. have to have the privilege of acting recklessly? How long can there be these fiscal transfers? How long can there be dysfunction and sort of gridlock that just pushes over the finish line more money into the pockets of people? I don't know the answer to that, but so far it seems like for a very long time.
Is that your way of talking about the auction a little bit later?
Of course. That was my side.
Is it 30-year bonds later?
$22 billion.
There we go. You've got the numbers memorized, haven't you? I know you have. Coming up on this program, former New York Fed President Bill Dudley on the Fed's next move. That conversation up next from New York. This is Bloomberg.
names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
You never hear people saying, I want my little boy to grow up to be an insurance person. Did your parents tell you to be in the insurance world?
I really liked the insurance sector at the time. We are basically promoting and ensuring social cohesion. And at the time, I wanted to make a difference and wanted to go in there.
Let's run through the price action for you on the S&P 500 equity futures. Waking up this morning positive by 0.1%. On the Nasdaq going absolutely nowhere. Amazing to see another all-time high on the S&P 500 in yesterday's session. Not what you would have guessed based on how CPI came in yesterday, hotter than expected. When we started sort of market to market our commentary around the story as stocks started to rally yesterday, I think we both said at the time, Lisa, maybe taking some comfort with shelter, not running away in quite the same fashion as we did in January.
But how many reports did you read before the CPI report came out that said this is the biggest risk event? If we get a hotter than expected CPI, expect risk assets to sell off. We get a hotter than expected CPI, who cares, right? I mean, again, it sort of raises this question, what's the real story here? And what's the narrative that markets
Well, the underlying story keeps changing, and that's the confusion for the economists on Wall Street. So now all of a sudden, goods, core goods, are starting to surprise to the upside. Services are starting to soften, and you've got to make your mind up. Do you have confidence in one more than you have confidence in the other? And do you really believe that goods disinflation has ended? That's finished. That process is complete.
I'll give you an anecdote, right? Especially because people got comfort from the fact that home prices didn't accelerate in the same kind of fashion that some feared. This morning, their mortgage rates actually dropped a couple basis points, 18 basis points, to 6.8%. All of a sudden, mortgage applications surged upward, right? So here's the thing, right? This is a market that as the financial conditions ease, you start to feel that pressure. And it raises this question, going back to the cookies, the cooling cookies. Is the oven still on? And if you put the pan on the oven, do they cool at all? And that, I think, is one of the key questions.
Ken Griffin kind of referenced this. I mean, he didn't reference this, but he addressed it, okay? We'll talk about the Ken Griffin comments later. He didn't talk about cookies. I want to turn elsewhere to the bond market. 2-year, 10-year, 30-year. Yields up a little bit this morning by a couple of basis points. 460.93. A few Mondays ago, in the 470s. We came all the way back down to the 440s on Friday. So we've been all over the place in the last 2 weeks. Up 2 basis points at the front end. Up about a single basis point on a 10-year. 416.64. Let's finish on foreign exchange. We won't talk too much about the euro. We've heard from a couple of officials on the Governing Council leaning towards the month of June for the first rate cut. The euro's a little firmer at 109.40. I want to sit on the Japanese yen, dollar yen 148, just to see that the auto manufacturers are having wage negotiations, and that's part of the story, the equation for where you want to be in foreign exchange based on where the BOJ is going to be in the next few months. So we heard it from the likes of Mazda, Honda, and we're hearing it now from Toyota as well.
And we're going to get that key moment. This is the moment
Friday.
You've been waiting for on
Biggest
Friday.
data point of the week.
I mean, are you even going to go to sleep? Or are you going to stay up, pull an all-nighter, and just watch the wage negotiations and unions in Japan? This really is the fact. This is where we are. Is this the deciding factor for a central bank that's taken the better part of 2 decades to make any move at all? Is this going to be the moment where
I'm
they
doing
start to
live
raise rates?
coverage from my house, Daybreak Asia with the team.
I will watch that.
I'm taking Friday off.
I will watch that. You're taking Friday off? No, you're not.
I'm taking Friday off. No, I'm working overnight.
No, you need to pump it up. We're going to be getting the key important data point.
I do the Japanese yen from home, okay? 147.99. We're positive there by 0.2%. I've always dreamt of doing that, just sort of sitting at home, and then it actually happened, and I hated it for months.
Yeah.
Under surveillance this morning, the House voted today on a bill that would force TikTok's Chinese parent to sell it or face a US ban. TikTok's CEO lobbying lawmakers on the Hill yesterday. Democratic Senator John Fetterman telling TikTok it's wasting its time, saying this. I love this. It's just so honest. I've spent hundreds of dollars on drunk elephant at Sephora because of my tween. That's annoying, but I think there's a security issue as well. I'd hope so. And if they have nothing to hide, then TikTok should be the first one to say, let's remove any kinds of possible connection there. And I support that. Hey, look, at least he's honest.
Well, look, when I saw this quote, I literally thought of Lisa immediately because she's been talking about the fact that these tweens are on TikTok and then running into Sephora and buying all their skincare needs. I think a lot of parents at least resonate with this. But before he talked about Sephora, he said that TikTok actually called him and they were trying to get him to back off this. And he said, look, I was honest. I was clear with them. I think this is a national security risk and I'm going to move forward with it.
How much have they spent on lobbying? I've got it in front of me. ByteDance spent a record $8.7 million on lobbying federal government last year. These are big numbers.
These are huge numbers and not just TikTok lobbying. Then you have to think for Club for Growth. They now have Kellyanne Conway lobbying on behalf of them because there's individuals within that organization that do not want to see this go through. But one thing that is kind of fascinating about this story is that, yes, they spent a tremendous amount of money lobbying. The story has been happening for years, but they seem to be caught on the back foot when it comes to this particular bill that has been almost going on negotiations in secrecy. And that is why you saw Shou Chu run to Congress yesterday to try to make sure he's having these meetings with lawmakers.
It's not working. We'll turn to another story. The president of Poland warning Russia will attack other states if it wins the war in Ukraine. President Duda making the comments in an interview on Bloomberg's Balance of Power yesterday after a visit to the White House and a meeting with Speaker Mike Johnson. Poland is pushing the US to approve further aid to Ukraine. The Biden administration announcing a $300 million military aid package, the latest effort to secure aid with Congress at a deadlock. Look, we've talked about where the former president has been successful and where he struggled. He's certainly struggled to blow up the TikTok effort. When it comes to foreign aid, he's been pretty successful.
He has been successful. The only issue that he was not successful in was his comment about NATO. Poll after poll, research shows that Americans continue to support NATO or want to see that support even go higher when it comes to NATO countries. When it comes to that foreign aid, Jonathan, that bill was bipartisan in the Senate, got absolutely blown up when it comes to the House of Representatives.
I promised you these comments from Citadel founder Ken Griffin. This is what he had to say. Warning the Fed must move slowly in lowering interest rates to avoid having to reverse course down the line. Speaking at a conference in Florida saying this, quote, pausing and then changing direction back toward higher rates quickly would be the most devastating course of action to pursue. Ken Griffin, Lisa, of Citadel.
And this is really the fear that a lot of people have been raising. The idea that the Fed is missing some of the heat in the CPI that people are dismissing is simply one-offs. If that's the case, what is the risk of keeping rates higher for longer? This, to me, is one of the key questions you hear Fed officials asking as well. If there is no risk, why cut?
It's the question to ask officials. What is the biggest risk? Cutting too soon? Holding too long? I imagine that data point over the last couple of months has just changed that risk just a little bit. I'm not sure if it's changed the base case, but it's changed the probabilities around the story.
Which is the reason why I think it'll be very interesting to see this press conference, next week, and see whether they change any of their dots, yes, but whether you hear a slightly different tone from Fed Chair Powell.
That meeting a week away today, looking to guide the economy to a soft landing while pushing out the first rate cut. Former New York Fed President Bill Dudley warning the next goal is reducing QT, writing this in Bloomberg Opinion. A final plan should be in place by the middle of the year. Whatever happens, the destination matters a lot more than the speed. I'm pleased to say that Bill Dudley joins us now for more. Bill, let's talk about this. What kind of considerations go into making a decision like this one?
You want to behave in a way that does not risk causing turbulence in financial markets. So the reason to do the taper is you're not really sure what the desired level of reserves is in the banking system. So you want to approach the runway very, very shallowly rather than steeply, especially when you don't know where that runway exactly is. So I think the taper is a prudent course of action. It doesn't really matter if you get to the desired level of reserves in 2 years versus 1 year. It's just the fact that you get there. So I think that they're going to discuss it at the March meeting. That was made clear by Powell's last press conference and in the FOMC minutes. And then they'll talk about the staff's proposal. And I think we'll see a final plan by mid-year.
Bill, you've said the central bank needs to shrink the balance sheet enough to rebuild the stimulus arsenal? I just want to get into that a little bit more. I've said this to you before. I feel like this is some kind of Jedi mind trick at the Federal Reserve. They want you to simultaneously believe that QE stimulates and QT does nothing. Bill, what does QT actually do?
Well, QT does withdraw restraint that they've put into the system previously. But economists who have looked at QE versus QT find big effects when there's QE announcements, very little effects when there's QT announcements. And the reason is sort of obvious. You don't ever know when a QE program is going to be implemented. The economy has to be really falling apart. Interest rates have to be at the zero lower bound. So QE is usually a surprise. QT, though, once you've done QE, you know QT is going to follow at some point. That the Fed's going to ultimately unwind the QE that they did earlier. So when QT happens, it's really a question of timing and magnitude, duration, not whether it's going to happen or not. So it has pretty much more milder effects.
There's also a Jedi mind trick going on, Bill, when it comes to financial, just in general conditions. The fact that we've seen dramatic easing in financial conditions, and that doesn't seem to be weighing on the Fed in terms of how that affects their ability to get to 2%. But when you saw a sell-off, that was concerning and some sort of restriction. Does that concern you that the easing in financial conditions doesn't seem to be anywhere on the radar of Fed officials?
Well, I think it's in the radar in the sense that the reason why financial conditions have eased is because people expect the Fed to cut rates this year. So, but the Fed actually has to cut those rates to keep financial conditions where they are today. I think at this point, we know that March is off the table. May is probably off the table too. We're really talking about Fed cutting rates probably sometime this summer. The focus at the meeting, as I said, is going to be, Paul's going to get a lot of questions about the QT taper since people know that's on the table. But the other thing that's going to get a lot of attention is the summary of economic projections and how many rate cuts do Fed officials pencil in their forecast. Last time the median was 3. I would guess the median will be 3 again this time. But there's some possibility, given the firmness in the inflation data, that maybe those are only going to be, the median is going to shrink to 2. But I bet they keep where they were last time. There's still plenty of time, still plenty of meetings this year to cut rates 3 times.
But this goes back to the question that we've been asking all morning. Has the balance of risks, arguably on a minor way, shifted just a bit after the CPI print to the fact that maybe it makes sense for them to hold rates higher for a bit longer because it doesn't seem like it's dampening some of the economic activity or materially harming the U.S. economy?
I think it has, but I think that's been their strategy all along. I mean, the market got way ahead of the Fed earlier this year when the market was pricing in 6 to 7 rate cuts this year, and the Fed was saying, no, we're going to do quite a bit less than that for the very reason that you said, that the Fed wants to be sure that they're actually be successful in getting inflation all the way down to 2%. And the not so good inflation prints that we saw recently, just reinforce that. So I think the world is sort of going the way the Fed Reserve was expecting rather than the way markets were expecting. And I think that I think there's plenty of time to see how the balance between growth and inflation plays out. As you know, these are balancing acts now. The Fed is focused on both sides of its dual mandate, not just inflation, but also what's happening to the economy. And while the economy has held up quite well, there are signs that it is slowing. And so the Fed is trying to get the balance right between these two risks.
Bill, this is the total opposite of the conversation we had post-GFC. I was talking about this a little bit earlier in the program. I want to do it again with you. I think it's important. Coming out of the great financial crisis, 07, 08, 09, we always had these charts that came out, and it was basically Wall Street looking for liftoff at the Federal Reserve, and then you had Fed funds just doing nothing for years. And every single year it was liftoff's coming. It was false dawn, false dawn, false dawn. Are we looking at a situation that could be the total reverse of that, where we have again and again just a false dawn looking for cuts that never come because this expansion just looks so much better than people thought it would be?
Well, that really depends on how tight monetary policy is, and that's one thing we don't really know. Every time the economy turns out to be stronger than expected, people start to talk about, well, maybe monetary policy is not as restricted as we thought. This comes back to the discussion of R-star, the neutral federal funds rate. One other thing that's going to be interesting in the upcoming meeting is whether Fed officials raise their estimate of what a neutral monetary policy looks like. If you look at the current projections, they think that at 2% inflation, the federal funds rate to be neutral should be 2.5%. And it's very possible, given the strength of the economy that we've seen over the last year, that they're going to start to push up those estimates.
Well, that's exactly where I wanted to go. Katie Kaminsky earlier was saying there's a real signal from the fact that financial conditions have eased so much in the face of rates that have remained so high. Do you take that signal? Do you think that the Fed should be lifting their R-star rate, their neutral rate expectations?
Yes, I do. I think there's lots of reason to think that R-star is higher than it was in the recent past. Fiscal policy has been very expansive. The government has put in place a number of new investment programs, CHIPS Act, infrastructure spending, climate finance. So all those things are increasing investment relative to a diminished savings pool that we should raise our star over the longer run. I also think that financial conditions are the right way to think about monetary policy. And so to your point, if financial conditions are easier, then there's less easing for the Fed to do.
Bill, just a final question from me. You've alluded to this, but just to speak a little bit more clearly on the topic, how uncomfortable should they be, will they be with yesterday's CPI print?
I don't think the Fed takes a lot of signal from one or two inflation prints after a series of very good inflation prints. But I think, the fact that it's now two rather than one it's now on their radar screen.
Bill Dudley of Bloomberg Opinion. Bill, appreciate it. Thank you, sir. They were looking to gain confidence. Have they lost some in the last couple of months?
What we heard just there is, on the balance, yeah, you have to think that on the balance they have a little bit, and I would agree with that.
Federal Reserve decision, about a week away. Let's get you up to date on some stories elsewhere. Here is your Bloomberg brief with Yahara Hackes. Hey, Yahara.
Hi, John. Fires erupting at a major oil refinery in Russia after a drone strike from Ukrainian forces. The facility, about 120 miles away from Moscow, serves as a key supplier of fuel for the eastern part of the country. The strike marks the second instance this week of Ukrainian drones damaging Russian energy plants. President Vladimir Putin saying the attacks aim to interfere with Russia's presidential election this week. Back in the U.S., questions about President Biden's mental fitness took center stage on Capitol Hill during special counsel Robert Hur's testimony. He's the prosecutor who declined to charge the president over his handling of classified documents. And in his report, he described President Biden as being a well-meaning elderly man with a poor memory. Hur defended his decision, saying, quote, "I understood that my explanation about the case had to include rigorous, detailed, and thorough analysis. I could not simply announce that I recommended no criminal charges and leave it at that. I needed to explain why." Shares of Dollar Tree are lower in the pre-market after the company's first quarter earnings guidance missed estimates. Its fourth quarter sales and earnings also coming in lower than expected. Plus, the company said it plans to shut 600 Family Dollar stores. The Dollar Tree CEO expecting to face headwinds in the first half of this year, but hoping favorable freight rates ease the pressure later in 2024. And that's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, rounding out a big week of bond auctions.
We definitely think inflation's the second half of this year's story. And when that happens, then you see less people being willing to buy bonds and the supply come back into the picture as well.
Another big auction coming up a little bit later. That story up next.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Stock's doing okay, better than okay. We've just been spoiled. It's been record high after record high. Got another one in yesterday's session. Equity futures right now positive by 0.1%. Yields up a single basis point, 416.64. Light on economic data this morning, heavy tomorrow. Retail sales, PPI, jobless claims just around a corner. Under surveillance this morning, rounding out a big week of bond auctions.
People will buy treasuries as long as the economy is resilient. I think inflation comes back on the radar the second half of the year. We definitely think inflation's the second half of this year's story. And when that happens, then you see less people being willing to buy bonds and the supply come back into the picture as well.
Here's the latest this morning. This week's Treasury auctions concluding with $22 billion of 30-year bonds. This after the 10-year auction drew some lackluster demand. Winnie Caesar of Credit Suisse sticking with her call of 3.75% on the 10-year yield and expecting the yield curve to steepen into positive territory by year-end. Winnie, I'm pleased to say, joins us now for more. Winnie, a few pieces of that puzzle. Piece one, you believe there is a May start to rate cuts and I believe 100 basis points of cuts this year. Why doesn't the data point to start the year, January, February CPI, change that story?
So, John, good morning. Thanks for having me. I think that the CPI prints have definitely been something that we've been paying attention to, but they're not the only pieces of economic data that we're looking at. We did have a consistent with potential cuts payrolls report last Friday. We've seen some other places that prices have come down in the ISM reads. And so when we put the broader picture together, we do feel comfortable that the economic data, while not wholesale cooperative, is inching towards the likelihood of a cut in May and further cuts after that.
Although, Winnie, I have to say, there seems to be these sort of two-sided stories. On one hand, you've got resilience and strength in corporations, which is the reason why spreads are coming in and risk assets are rallying. And on the flip side, you're seeing signs of weakness that people point to for the reason why inflation will keep going down. Which is it?
So it's a really tricky one. And I think that we have to remember that as inflation moves down, that is positive for corporations from the price perspective, right? A lot of the challenges that we saw in corporate earnings in 2022 were very much related to input costs, to energy costs being higher, to shipping costs being higher. And at the same time, we've started to see that deceleration in the ability to pass things through to the end consumer. And so it's always that balance that corporations need to strike to really hit that sweet spot in terms of maintaining margins and not needing to do widespread layoffs. And I think that we are kind of approaching that better equilibrium in the corporate earnings cycle.
I guess I'm struggling to understand how you can say on one hand, rates are restrictive, and on the other hand, you're seeing, in some cases, record paces of debt issuance, both in the government and on the corporate side, and you can see that demand for it is just insatiable. I mean, what message do you take from that, given the fact that it seems like companies are managing just fine through the cycle?
It is a really interesting dynamic, especially the demand component, as we have seen a significant return to demand really across a broad base of investor types into fixed income, especially in the U.S. markets, also in the European markets. And I think what that signals is most people are not anticipating a re-hiking cycle or a re-acceleration in inflation that would drive more rates volatility and higher yields overall. Instead, people feel pretty confident to say, okay, rates are probably at near the peak and we are okay putting cash to work in fixed income, even if they hold steady around these levels.
Although I have to wonder at what point going forward, you start to push back a little bit. We've seen triple C's in particular, some of the riskier segments, really start to rally as people search deeper into risk at a time where people are saying survive till 25 and 2025, you're going to have this real maturity wall. Have people gotten a little ahead of themselves?
So I think that people are being very circumspect in trying to figure out what are the appropriate triple C's to be buying and what are the more leveraged balance sheets that are just not going to work in a higher for longer or sustainably elevated rates environment. Where we're a little bit more concerned about people getting ahead of themselves is perhaps on the leveraged loan market, where elevated policy rates for longer than expected are probably going to play an even more detrimental role in fundamentals there.
Winnie, I just want to finish on Japan. We're about to see something we haven't seen since 2007. Lisa's been talking about this for a while. Why do you think global fixed income is so comfortable now with something we've been waiting for a long, long time? I remember all the bear arguments about what would happen when they had to get away from QE in Japan and start hiking interest rates, that it was going to be the end of fixed income, yields were going to surge worldwide. Why isn't this going to shake up corporate credit in America, treasury yields, etc.?
Well, I think that we now have the benefit of two very aggressive policy cycles in the US and in Europe, giving investors a little bit more confidence that the global economy can actually withstand elevated rates, especially when liquidity in the global financial system is really quite robust, and we continue to see kind of at the fringe fiscal policy support as well. And so now we just have a little bit more evidence that, higher yields is not necessarily going to cause that cataclysmic rollover in the financial system.
Winnie Caesar, Credit Sites. Winnie, thank you. That is quite a change, Lisa. And it started in Europe for me, for the ECB. When the ECB started hiking interest rates, I never thought they'd end up where they've got to. I certainly didn't think they could do both that and then QE without there being some major problems on the periphery. And there haven't been. I know they had hiccups along the way and they had to come up with certain programs too, but we didn't see the big issues that many people expected.
I hear you. I'm on the same page. I think a lot of people are. Everyone was talking about Armageddon in the debt market if you saw rates ever rise, and all of a sudden, here we are, things just moving along swimmingly. It raises this question about the fiscal transfers that we heard from Winnie Caesar. We heard that from Bill Dudley. We've heard that from every guest who's come on, that's been the big surprise that's really fueled a lot of the strength that we've seen. How long can that go with governments basically transferring their balance sheet to private balance sheets?
Yeah.
I don't really know the answer, but that's what I keep thinking about this morning through all these conversations.
I'll go back to the conversation we had with Howard Marks of Oaktree just in the last week. This is what we talked about with him. Where's the leverage? Where's the leverage? Corporate balance sheets are stronger. Household balance sheets are stronger. They are stronger because the leverage went to the sovereign balance sheet. And yet here we are. Here we are, even with all these rate hikes, even with the end of QE, rates haven't spiraled away in the way that I think the biggest bears would have thought they would have done.
That's the reason why I watch auctions. And every time they just go through, yesterday was a little weaker. Today we've got the 30-year auction. People aren't pushing back in a material way because they're still counting on the fact that rates are going to reflect an inflation rate that is coming down, not necessarily this premium that's baked into transferring the wealth of a country into the balance sheets of companies and corporations.
Now, granted, the BOJ is still targeting 0% on a 10-year, I believe. Yeah.
I mean, what is the 10-year right now? I mean, I think it's actually above zero, though, so.
Yeah, there's been some tolerance, some increased tolerance of to how that breaks out.
0.1.
Yeah, big changes over the BOJ. I mean, we might actually get a rate hike.
I know.
Which is something.
To zero.
Yeah, okay. Coming up, Mandy Zhu of SIBO. I mean, it's so well said. FCC Commissioner Brendan Carr, Stephen Stanley of Santander, and Bloomberg's Ed Ludlow. More still to come, live from New York City this morning. Good morning to you all. Equity futures on the S&P 500, slightly positive, no drama, up by 0.05%. In the bond market, yields higher by a few basis points, up 2 at the front end of the curve on a 2-year 4.61, on a 10-year positive 2 basis points today to 4.17. This is Bloomberg, the third hour of Bloomberg Surveillance, up next.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have 2 assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
They're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
I think inflation is a story of the past. You may have some hiccups here in the short term that could create some near-term volatility.
Our highest conviction view this year was volatility. I think inflation comes back on the radar the second half of the year.
What I think is going to happen over the course of this year is, yes, inflation is going to come down slowly.
That deep inflation tail risk has kind of been cut off. So if you were to get inflation to a level where we have to kind of respect that tail again, then yeah, that becomes a real risk for the market.
The broad index is telling you a message. Inflation's sticky.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. Your equity market on the S&P 500 just about positive after closing at all-time highs in yesterday's session. Anticlimactic in so many ways. It's the calm after the storm, Lisa, that never came.
That's been the story of the entire year. Basically, everyone's calling for a storm, people coming out, this can't last, it could be a bubble, can't take it. Guess what? We're now north of 5,200. The year-end price target that people upgraded to just a month ago. When do we get people upgrading to 56, 57, 5,800? Because this train keeps moving.
It's kind of snoozy this morning, and I welcome it. We're looking ahead to retail sales tomorrow, PPI and jobless claims. We're light on data this morning, AMH, but tomorrow, looking at claims, 218 is the estimate so far in our survey. That is barely moving from the 217 in the previous week. And historically, if you plot a chart, that is very, very low.
Yeah, it is very low, and it's something that obviously this is one part of the mandate that the Fed is very happy with. Under 4% for unemployment for 2 years. Remember the depths of the pandemic. Also, when Biden came out yesterday to talk about the inflation report, obviously he leaned into the good things out of the report because you can just extrapolate what you want to prove your thesis if things are getting better or if you're concerned things might be getting worse. But again, he pointed to the job market, which I think is the White House's way of saying we know inflation is still a little bit rough and sticky for some parts of the consumer, but look at the job market. Unemployment under 4% for 2 years.
I love what David Rosenberg said. People are looking at the economy like it should trade like Bitcoin. It doesn't. It's a slow-moving train. I understand that, but it just is hard to get a signal, given the fact that, we're trying to read in, Bitcoin-like moves.
Isn't that a Wall Street bias?
Of course.
Everyone wants everything fast.
Well, yeah.
You want to turn the page on the chapter.
Well, normally you have a
Get to the end of the book really quickly.
Okay, you're talking, I know, you're calling me out. I did that as a child. I was 100% that
You went to the
person
end.
who read the last
We
page.
all did that, Bramo.
What? Yes, anyway.
You ruined the entire book.
No, it's that I couldn't handle the suspense. Then I could enjoy the rest of the book. But here's a question. At this point, if we don't know what cycle we're in, That's the frustrating thing. How do you know what paradigm to really even invest in?
Impatient Bramo, I can't imagine that.
Oh,
That's
all right.
No
Enough
way.
with the sarcasm.
Equity futures on the S&P 500 look like this. Equities are totally unchanged to slightly positive, up by 0.04%. Yields are higher by 3 basis points. Bit of price action in the bond market for you. Into some supply at the long end of the curve later. 417.81 on a 10-year. Lisa, on a 30-year, up 2 basis points to about 434.
And we do get that auction later today. I am curious about it. Remember when Stuart Kaiser came on yesterday and said, can you imagine if we get a hotter than expected CPI and then a weaker than expected 10-year auction? Guess what? We got a hotter than expected CPI and we got a weaker than expected 10-year auction and no one cared. Right? Do we get the same kind of thing today, given the fact that we've got $22 billion of 30-year bonds being auctioned off at 1 p.m.? Really a key question.
It just had the biggest one-day move higher on the S&P 500 of the month so far. Coming up, CBOE's Mandy Zhu on volatility across asset classes. FCC Commissioner Brendan Carr joins us to discuss the House vote to ban TikTok. And Santander's Stephen Stanley looking ahead to next week's Fed decision. He's forecasting only 50 basis points of cuts this year, and those cuts don't begin until after the election. Looking forward to that a little bit later. We begin with our top story. Stocks hitting fresh all-time highs, even with February CPI coming in hot. An equity decline lasting only a few minutes, giving way to a rebound, pushing the S&P at more than 1%. That move only happening on a handful of CPI days since March 22, typically on the back of a lower inflation print and not a higher one. CBOE's Mandy Zhu saying this: equity volatility has declined significantly over the past year. Low volatility isn't a unique feature of the equity market, but a phenomenon we're observing across every asset class. Implied volatilities have fallen broadly and significantly across equities, credit, FX, and commodities, suggesting that what is driving the VIX lower is very much macro fundamental in nature rather than equity specific. I'm pleased to say that Mandy joins us now. Mandy, good morning to you.
Morning.
Last time we spoke, you said this market was positioned and biased towards further gains. Is that still the case?
It's very much still the case, and I think that's, surprised a lot of people, because I think going into year-end last year, you can justify it because of positioning and the need to chase the upside. To start the year, we flipped the page, and guess what? Exact same dynamic playing out in the derivatives market. We're still seeing extremely low levels of skew in the derivatives market, meaning no demand for downside, and everyone's chasing that upside. Now, a lot of questions around whether this is euphoria, whether the momentum has gone too far. One thing I would point to maybe say that this potentially could be justified is if you just look at the underlying S&P 500 index, forget about the options market. One of the things that we've noted is that S&P has actually been more volatile on the upside than the downside, which is very different from how it historically behaves, right? So historically, markets crash lower, grind higher, and that's why puts trade at a premium to calls. Over the past 2 years, the vicious move has all come to the upside. So more volatility on market up days than down days, hence the need to use options to manage that volatility becoming greater on the upside.
Would you describe yesterday as a crash higher?
Exactly. I think because it's been consistent year to date as well, the biggest moves have all come from the upside, not the downside. And you'd have to go back over 20 years to find a similar period when we've seen this inversion in terms of how markets are behaving.
Are you seeing a lot more money coming in, kind of lured in by FOMO? Why is it that there are these sort of vicious moves upward? Do you have a sense of the anatomy of that?
I mean, I think people are still coming into the year. I think, we're talking about where's the next leg higher going to come from. And sure, on the macro side, people have kind of reduced expectations of Fed rate cuts. But, look at earnings. Earnings came in very strong. I think that's going to be what is propelling stocks higher going forward is the fundamentals. And then, you look at the money on the sidelines, are we, can positioning increase from here? I think it can. And certainly people are using options as a way to lever up their equity exposure.
We've had a number of guests say that they expect volatility to pick up more materially as the year goes on. I know you laugh because everyone's been saying that for the past 5 years and it only happens occasionally, but I am wondering whether that matters even if the volatility is to the upside. If that's the case, then does an increase in volatility even matter?
No, I think it does. So when volatility picks up, people, tend to de-risk their portfolio, right? Whether you're a systematic investor or a discretionary investor. So a pickup in realized levels of volatility in the market matters, but exactly to your point, when and where it's happening also matters. And the fact that right now it's been happening to the upside, I think is what is really underpinning a lot of the dislocations that we're seeing in the derivatives market.
Is this what you call how to play options when it comes to U.S. exceptionalism?
So that's a great theme that people are focusing on, right? So everyone well aware that the U.S. rally is very much driven by a handful of names, right? And there's a huge concentration risk. So to start the year, what we have seen in terms of themes is people looking elsewhere globally, right? Can Europe outperform? Can Japan, can emerging markets, ex-China do well this year? So one of the things that we're very excited about actually next week is we're launching options on 3 new MSCI indices, MSCI ACWI, World, and USA, to kind of help investors play that global, international versus U.S. theme and gain exposure to international markets using options.
How much of this is coming from institutions in terms of the trading, and how much is coming from day traders that are really into the 0 days to expiration options? But this is what we were all talking about. I mean, we were talking about this, a while ago. How much is this people playing in this and trying to get a hold of it through their Robinhood accounts?
It's both. I mean, I think the growth in retail usage of options in the derivatives market, over the past couple of years is certainly notable, but it's not just retail. It's not just FOMO, right? Institutional investors, and you see it, for example, through the growth in income option strategies over the past couple of years as well. Institutional investors and retail investors are alike turning to options, for leverage, for directional exposure, but also for income. That's been, very much the story over the past couple of years.
And there is a gambling element to this as well. 0 day to expiry. You've continuously and consistently said that's not something we should be concerned about. Can we just go over that ground again? Why shouldn't we be?
Sure. So the data, when you look at the data and the breakdown in the flows in terms of the 0 day options, it's actually very balanced. I think that's what's surprising to a lot of people. It's, yes, absolutely, there's a segment that is, of investors who are using 0 day options for speculative purposes. But like I mentioned before, there's also a very meaningful segment that are using those options for yield. So they're selling these options. So when the buy and the sell are balanced, the net impact on the market is very de minimis.
Let's finish where we started. You talked about the bias being positioned to the upside. Is that still more pronounced in small caps? Because that's what you said maybe a month or so ago. Is that the same?
Exactly. Yep. So if you look across all global indices, Russell 2000 currently stands out as the index with the flattest levels of skew. And that's really on the back of that upside call demand. So positioning for a broadening out of the equity rally away from the large caps towards, whether you look at equal weight S&P or small caps, that's definitely been where the interest has been.
Interesting. Mandy, it's good to see you.
Great.
Always is. Thank you. Mandy Zhu there of SIBO. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. German automaker Volkswagen is expecting orders in Western Europe to pick up as it updates popular models like the Golf. The company is looking to rebuild momentum in EVs and push forward with an ambitious savings plan as competition grows abroad. The Volkswagen CFO telling Bloomberg a drop in China's market share can be eased by growth in North America.
We are deliberately prepared to give up market share in the next, I would say, 1 to 2 years, 2024, 2025, in order to find a sound compromise between margins and volume. But from 2026 onwards, we want to regain share also in the BEV segment.
China's BYD overtook Volkswagen as the best-selling automaker in China last year. U.S. mortgage demand is growing as rates drop back below 7%. Data from the Mortgage Bankers Association says applications for home purchases grew 4.7%, hitting a 4-week high. Despite mortgage rates falling from October's peak, rates are still twice as high as they were in 2021. The data covers more than 3/4 of all residential mortgage applications in the United States. And a dark side to the weight loss frenzy. UK authorities seizing thousands of packages containing fake versions of Ozempic. As demand for the treatment has risen, authorities say so has activity by organized crime, plus lone entrepreneurs looking to cash in, many advertising on social media. Patients across the world have been hospitalized after using counterfeits, with some found to contain lethal doses of insulin. And that's your Bloomberg Brief. John?
Yahara, thank you. That is pretty scary, isn't it? I'm not sure we should describe them as lone entrepreneurs. But sort of like, that's pretty scary.
It is pretty scary. And it really raises this question, how quickly is this getting developed before it's getting distributed in a way that people are looking for?
Yeah, kind of shocking. Up next on this program, TikTok in the hot seat.
Your platform is basically an espionage arm for the Chinese Communist Party. Why should you not be banned in the United States of America?
Senator, I disagree with your characterization.
That conversation up next.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Live from New York City, equities just about unchanged on the S&P 500 after closing again at all-time highs in yesterday's session. Yields creeping higher once more.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level up your leadership. Because ultimately, the job of a CEO is to do three things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Conduct at issue here, the Constitution does not compel us to require a national security threat to continue to persist.
Well, there's one politician in D.C. who certainly likes TikTok, and that's President Biden. In the sense of his campaign, they feel like they're able to reach the youth by using TikTok. So if TikTok is divested, there's a sale, would that mean that the Biden campaign can continue using it, but do you think it'll be safer?
Yeah, that's right. You know, a lot of people raise that concern about the Biden administration being on TikTok, but Biden administration officials have been very clear that there's a national security threat here. That's why passing this bill actually squares the circle, because then the campaign or anybody's campaign could continue or start to be on TikTok, but without that serious national security risk that's present today.
Commissioner, given the fact that we've heard that from President Biden, I'm curious about your comments from the former President Trump, who seems to be, I don't know, less clear about what he thinks of this bill, saying, you know, that there's a lot of good, there's a lot of bad with TikTok, talking about how it increases the prevalence of Meta. What do you make of his comments?
Yeah, I think, first of all, President Trump, you know, fundamentally reshaped Washington, D.C. to understand the serious threat posed by the CCP. He's also raised concerns, as I have, with the conduct of big tech companies that are based right here in Silicon Valley. And those are real concerns. He pushed for Section 230 reform, which I supported and had hoped we would have gotten across the finish line at the FCC by now, and we haven't. But TikTok presents obviously sort of a threat that's fundamentally different than U.S. big tech companies. For all of my concerns with their conduct, and I have many, once we deal with the national security threat from TikTok, once you break that tie back to the CCP, then we should move very quickly, as President Trump has outlined, on Section 230 reform, and in my view, affirmative anti-discrimination obligation that would apply across the board. But until you break that link to the CCP, a lot of other reforms just aren't going to work out.
But it does feel like he flip-flopped on this in the sense that he wanted to ban it under his administration. It then got held up in court. And now he's saying he's really not so sure about it. Do you think we could see a different, if he was to become president of the United States, a different view on TikTok because of his concerns of how big Meta is?
Well, again, I think the reason why this bill is such a smart approach is because it's not a ban bill, it's a divestment. And so you would have TikTok go to a different, doesn't even need to be a U.S. company. It could be any company that's not tied to China, Russia, North Korea, or Iran. So you can continue to have TikTok in the marketplace as a counterweight to Facebook, as a counterweight to others, but it can be there in a way that doesn't present the national security threat. So it keeps that competition high.
Commissioner, we seem to be ill-equipped to deal with these issues. It's been 4 years, about 4 years since we've been talking about this, and hardly anything has happened just in terms of actually passing proper policy to do something about these national security concerns. I think back to China, it's easy, it's straightforward. She comes out and says no, and then that's it. It's banned, it's all banned. Twitter, Facebook, YouTube, no access. Why are we so ill-equipped in the West to deal with these threats, and how do we go about changing that?
Yeah, we certainly have a very different system, obviously, than they do in China. And some people raise concerns about, will China engage in some sort of reciprocal action based on that? And I remind people, Facebook and other U.S. technology companies are already banned in China. So yes, we move more slowly. We move in a much more considered way. And obviously don't underestimate the fact that, you know, ByteDance has put every single amount of lobbyist dollar possible to slow roll this. And people look at the 118th Congress and they say, you know, they have a hard time getting things done as a general matter. But this is one where the 118th and Speaker Johnson can land a significant legislative win, not just on a tough issue, but as you know, on a technology issue where it's sometimes difficult for Congress to act. And that's why the Commerce Committee with Chair Rogers holding that blockbuster hearing last March, I think that really set things in motion. Do people wish it would have gone faster? Sure, undoubtedly. But arriving here today where there's a vote in the House is a significant moment.
Significant moment in the House, but what happens next in the Senate, Commissioner?
Yeah, I feel pretty good about the odds in the Senate as well. If you look back, actually, people sort of have forgotten this, but Senator Schumer joined in a letter with Senator Cotton back in 2019 raising serious concerns about TikTok's national security threat. So this is an issue that is a long-standing issue for Senator Schumer over there and many, many Republicans as well. So a lot of the focus has been in the House, obviously up to now. It'll now shift to the Senate, but I think the odds are very good there as well. And I'm looking forward, hopefully, to the bill passing today in the House and then things moving over there.
Commissioner, I want to finish on conduct versus content. You talked about this being a conduct issue. Do you believe there is a content issue in any way, shape or form as well?
No, not at all. I mean, look, sometimes we focus on the way the algorithm with TikTok performs, and people have focused on that, how it just shows content that is drastically different than any other social media, content that happens to align with the CCP. Again, it's not that content that's the concern for me. It's that that content shows there's such a drastically different operation of the algorithm that it goes fundamentally to conduct into CCP control. So when we talk about that, again, it's just further evidence of CCP control. It's not about the government acting based on content. Again, I'll give you one last analogy. Someone can take a pen and they can write the most salacious anti-American propaganda they want. There's nothing, rightfully, the government can do. But if you take that pen and you use it to pick a lock and break into a building, well, that's illegal conduct. We can take the pen, and it's no defense for you to say that you were using it to write previously.
Commissioner, appreciate your view this morning, sir. Thank you for joining us. We'll catch up soon. FCC Commissioner Brendan Carr on the upcoming vote that's going to take place down in Washington, D.C. Lisa, a little bit later this morning.
I'm just sitting here thinking about that. This question of, is the algorithm content or conduct? I think that that's ultimately a key question for a lot of these places, because what you're looking at is the algorithm deciding what you see, how often you see it, but isn't necessarily the content itself, or is it? I mean, this is sort of a key question.
Well, when he talks about the nefarious flows back to China and their ability to push what you see, that's when he said this is the conduct of that algorithm. Maybe that content wouldn't end up at the top priority list of, say, a TikTok user if it wasn't for that algorithm. And that's really where he takes issue with TikTok and it being, you know, led by ByteDance, which is based in China.
Remember David Rosenberg talked about Wall Street wanting everything fast?
Yeah.
Yeah, this.
Yeah.
It's going to take a while.
Well, it already has.
Yeah,
I mean,
taking 4 years. It's going to take
another 4 years.
Wow. And they're talking about exhausting legal challenges.
I mean,
I get it. It's a feature of what we have here in our system in the West, and not a bug. But part of that story is it takes time.
And it raises a question of what the U.S. is up against.
Stephen Stanley of Santander up next.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but you know, it is continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking,
box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down, right? So it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, you know, movie-going begets movie-going, right? So when there's a season filled with, you know, good movies that people want to see, you know, I was made to feel pretty optimistic about what we saw in the summer.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Stocks pulling back just a touch on the S&P 500. We're negative by, let's call it 0.1% on the S&P, down by about a third on the Nasdaq. A little bit of a move in the last 20 minutes or so. This from Citi just moments ago. The last mile problem for inflation. Sticky services inflation. Further evidence that inflation is not on a path to sustainably return to target. What does that mean for this bond market? The 2-year this morning, the 10-year, the 30-year shaping up as follows. 2-year yield higher by 3 basis points, Lisa. Back through 460.
If you take a look at the sticky inflation, just that component, the Atlanta Fed puts out this metric, and 3-month trailing, you're actually seeing it surge back up to 5%. This is the wrong direction. So I put that out on X or Twitter or whatever, and people say this is backwards looking, and really everything's going to be fine. So ultimately, this goes down to a belief structure, which is the reason why the market just simply doesn't believe the story that some of the data suggests at least in the headline level.
By definition, it's realized data, so it's backwards looking. I mean,
Exactly.
I take issue with that. That's ridiculous.
But we're data dependent, so depend on that.
Here's my issue. We're moving the goalpost. You're going to hear less about 3-month. You're going to hear more about year over year. They're going to find a way. You know, Steve Risciuto sat here of Mizuho.
Yeah.
And Steve was right in the following sense. Steve is basically saying that they want to cut. They want to cut. Now, maybe the data's not on their side right now, but can they move the goalposts? I think they can probably move the goalposts if they want to. They can start looking at different things.
They already have, right? I mean, the idea of, well, 1 data point doesn't matter. 2 data points, well, you know, okay, maybe a little bit more. In the past, it would have been something that was key. And before we got yesterday's report, it was the most important report since we ever got.
Yep.
And suddenly it doesn't matter that much anymore.
Just like that, bang. All-time highs and no one cares. Move on. Going to move on to foreign exchange. I want to talk about 2 currency pairs. Mentioned this a few times. On the euro side of things at the